Go ahead,
Well, then
Kevin.
I'll call the Board of Finance regular meeting with the joint meeting with the pension board to order Monday, May 17th at 7:06 p.m. And I'll read this so Eric doesn't have to. In accordance with Governor Lamont's Executive Order 7B regarding the COVID-19 pandemic, this meeting will be held remotely with no in-person attendance. This meeting will be broadcast live on OGAT, Channel 79, Frontier Channel 6063, and streamed on YouTube. And our board is Joe Nuzzo. I can't see everybody. Jim Leahy, PJ Shanley, Deborah Satanic, our secretary, John Cifarelli, and Pat Romano. And Kevin's not with us, right? I don't see him listed, so, okay.
Kevin Audrey also.
Oh, I don't see her either. Okay.
I'm in the stands at the game.
It's all yours, Eric.
Thank you, Kevin. So I'm Eric Henlon. I'll call the pension board portion of the joint meeting to order also at 7:07. And thank you, Kevin, for doing the introduction so I don't have to repeat it. And pension board is represented by myself, Mitch Goldblatt, Barbara Miller, and I believe Rebecca Harlow is here. Rebecca's our newest member. Welcome.
Hi.
So, Kevin, I'll probably turn the agenda over to you because I think the presentations that we have for this are more designed for the finance board.
Okay, great. All right, John, item 3, public dialogue. Did anybody email you anything regarding this meeting?
No, so you could go on.
Okay, great. Item number 4, presentation by Michelle Boyles of Milliman. Michelle, thank you for coming.
Thank you for having me. I'm going to share my screen. Hopefully everybody can see my screen right now. And I'm going to start off with walking through the police pension plan, and then I'll switch over to the town employees. This is a presentation that I typically walk through with the pension board, where we go through one pension plan and then the other. We go through them separately because they are distinct entities and there's information that applies to one that doesn't always apply to the other, but there's also a lot of overlap. So what you'll find is I'll go through in greater detail as we walk through the police plan information, and then I'm going to go through a little bit faster as we walk through the town side. But please do stop me, ask any questions as we go along. If there's something that I've gone over too quickly, or you just want me to elaborate on a little bit more, I'm very happy to explain further. So what I'm presenting to you today are the highlights of the January 1, 2021 valuation. So remind yourselves that right now we're standing on May 17th, but we're talking about information that happened and was measured as of January 1st, 2021. That's how we complete actuarial valuations. It's always a snapshot. It's just like we're working on financial statements. You have to have a measurement date. That's when we're looking at the information and analyzing everything. We can't keep it fresh every day because John and Audrey would go crazy with me calling and asking if somebody terminated, retired, or died. Is everyone still okay? They don't want to know that information. We don't want to keep up with it every day. That's not actually manageable. And so the frequency that the plan operates on is every year we complete evaluation as of January 1st. And we look at what the population looks like, and we look at what your assets look like, compare that information, and develop a contribution to be made in the following fiscal year. The fiscal year runs July 1 to June 30, so we're slightly mismatched when we're looking at the information. We actually will be looking at June 30th information when we go over to the accounting disclosures, but that's not the valuation information that we're looking at today. So we'll start off with the basic information of who are the people in your pension plan. This is actually some of the most important information because we talk about all of these numbers and it's very mystical information. But in the end, what a pension plan does, its whole purpose is to reward your employees for their service, for their tenure, which they've also contributed towards, and allowing them to retire, giving them a pension so that they can have a satisfying retirement and survive and not just rely on Social Security or something like that. So let's look at your population. The top very thin section of purple are terminated members. These are employees, former employees, who are no longer working for the town, but they are not collecting a pension benefit. They are due a pension benefit in the future. This is a very small group because especially when you're talking about police officers, they tend to be eligible to retire at relatively earlier ages, and they do retire at relatively earlier ages. And so you usually do not have a significant terminated population. They tend to continue working with the town until they can retire, and then they do. The largest section that you see continues to grow year over year is this golden members in pay status. This is a bucket that incorporates a few different types of people. These are everybody who is currently receiving a pension benefit, a regular monthly pension benefit. This could be former employees who retired and elected to receive a pension benefit. This could be beneficiaries of former employees who retired. Could be alternate payees, could be disabled retirees. This gold section is everybody who used to work for you or was represented by someone who worked for you and is now receiving a pension benefit. The small section, which has grown smaller year over year at the bottom, the light blue, is your active members. This is getting smaller and smaller every year because the pension plan is closed to new employees. When you close the pension plan, that means every time somebody retires or terminates, the new employee who enters the town, who enters the police force, does not join the pension plan. They're actually participating in a different pension plan. So their counts are not represented here. And so your population is just going to keep decreasing. Your active population will decrease. Your total population stays relatively stable over time, but as your retirees do pass away, it's going to start decreasing. It's natural behavior with a closed pension plan. What happened in the last year? 2 of your active employees retired, so it went from 5 to 3. And instead of your members in pay status increasing from 43 to 45 for those 2 retirees, it only increased to 44 because one of your retirees passed away. Looking at this bottom chart, it presents a slightly deeper dive into your active population. It's not very exciting because you have 3 active employees left. And what this is showing is where do your active employees fall within an age and service grid? Approximately how old are they and approximately how long service? The answer is very long service. Your average service is 30.8 years of service. Your average age is 55.6. All of your active police members could retire today if they wanted to, because normal retirement is age 55 or 20 years of service. So all 3 of these members could retire and start collecting a pension benefit without any reductions today if they wanted to.
Hey, Barb. Oh, excuse me, Michelle.
Mm-hmm.
Can you run that by me again? And maybe when I saw the term terminated members, I don't think I had the definition that you were explaining. So why don't you run that by me again, what terminated members mean? Because it kind of was surprising, the definition I heard the first time.
No problem. So why don't I actually work backwards? Because then terminated members becomes the everybody else category. Active members, the blue section, is everybody who is currently employed by the town as a police officer.
Got it.
So that is your current employees.
Got it.
Your members in pay status is everybody who is currently collecting a pension check from the town. So that's,
we could call that retired.
yes, retires. There's beneficiaries in there too. So we try to go a little bit more encompassing, but yes,
Okay.
it's your retired population.
Okay.
The terminated members is everybody else. So they are no longer actively employed with the town, but
Right.
they are not collecting a pension benefit.
But they will be.
They will be in the future. They are due a benefit in the future.
See, that's my conflict with the term. So whoever, God bless America, but, terminated members don't sound like somebody who will be doing anything other than being terminated. So whoever makes these definitions up, that's one man's opinion. But thank you for mentioning that.
Yeah, they're Unfortunately, there isn't a universal definition for all of these categories. It's a little bit loose and open to interpretation, and that's why I try to make sure that we do talk through what we intend to mean with these
So a
different.
terminated member will, by definition, become a retired in the gold section, right?
Correct. Eventually, they will move down there, and then everybody will be in pay status, and then everybody will eventually pass away.
Roger that. Thank you.
No problem. The bottom section does a little bit of a breakdown of all of your members and pay status. So like I said, this encompasses a few different categories of people who are receiving pension checks. You have your service retirees. There are 39 of them. That's most of the people in pay status. They are currently collecting almost $1.8 million in benefits a year. You have one disabled retiree, and you have 4 beneficiaries. So these are people whose spouses passed away and they're receiving the remainder of their pension benefit.
So this is a breakdown of the gold section, right?
Correct.
Hey, Michelle, it's PJ Shanley. I just want to jump in with a question. But first, I want to thank you for your presentation. I think you're doing a great job so far, explaining everything very clearly. I also want to thank the rest of the pension board for coming on today and accommodating our schedule and coming up with this presentation. But my question is there a cap on the pension? So I know with teachers, after 37 years, it's capped. Is there something like that with this pension as well?
Let me confirm for you really quickly. Off the top of my head, no, but there is no cap.
Okay.
They get 2.25% of their average earnings for each year of credited service up to 20 years, and then 2% of average earnings for each year in excess of 20 years. So it's a small step down in their accrual once they've reached 20 years of service, but there is not a cap.
So theoretically, if someone worked long enough, they could be receiving 100% with their high, whatever the factor is, high 3 or high 2 or high 4, or whatever it is.
Correct.
Okay, thank you very much.
Well, actually, PJ, couldn't it be, Michelle, I think I got your name wrong once. I didn't want to do it again. Somebody, if 2.5% for 20 years, that's 50. So if you did another 20 years, you'd had 40. Who knows who's going to actually do that? But you could conceivably, if you worked long enough, have over 100%. Is that correct, since there's no cap?
Correct.
Thank you.
It would be very surprising to see a police officer work that long.
Oh, roger that. I'm doing the math. That's all I'm doing.
Yep. And as you can see, we are down to just 3 employees left, so it's diminishing the possibilities.
Roger.
Any other questions on the population before we move on to assets? Great. So as you know, the markets have been very interesting in the last few years. There's a little bit of luck actually in that you have a January 1st measurement date, because other than January 1st, 2019, January 1 has not been a bad place to look at assets the last few years. What we're looking at is, on average, we're expecting something around 6.5. We're now at 6.25%. That's your expected rate of return on assets. So 3 out of the 5 years, you've exceeded that rate of return. That's not indicative of what we think the future will hold, but it means that you have had very good market performance in the last few years, which is always great, because the way you fund a pension plan is either through cash contributions or investment return. So when your investments return greater than you expect, that's going to be slightly less contributions you have to make in the future. It's always good news. When we're looking at a funding valuation, though, we do not use the market value of assets. We use a smoothed value that we call an actuarial value of assets. We do this because of the fact that markets tend to bounce up and down and up and down. And while that's important for us to look at when we're doing accounting disclosures, because we want to look at a mark-to-market basis, it's not very stable when you want to base your budget and your funding contributions. So we use a smooth value of assets that takes 5 years. It takes all of your gains and losses and recognizes them, straight line recognition, over a 5-year period. So 20% of every gain and loss is recognized each year. That means that actually in the last 2 years, your market value of assets is greater than the actuarial value of assets. So you can see how that's changed over time. And back in 2017, this olive green bar, the one on the right, was at 16.5. That was your actuarial value of assets relative to the market value was 15.5. But then we moved to 2018 and they actually stabilized and almost became exactly equal at 17.3 and 17.0. Then it flipped, went up again, where market value 15.5, 16.9 for actuarial value, because that was the year of the significant market downturn. You can see that nicely lining up how actuarial value kind of balances out when the market swings too far. In 2020, again, we were coming back a little bit closer to stable. Market value was a little higher than the actuarial value, but still pretty close and tight. Now we're standing in 2021, and we've had 2 very, very strong market performance years. And so in deferring those gains, we now have a slightly bigger gap between the market value at 19.9 and your actuarial value at 18.3 million. What does this mean? We're going to keep recognizing those gains. And so your actuarial value will catch up with the market value of assets. In the last year, you paid out 1.9 million in benefit payments. That's what we were talking about with your current retirees. And you made $1.5 million in contributions. This is something that you tend to see over the lifespan of a pension plan, where as it gets later in life, you are actually paying out more in benefit payments than you are putting in contributions, because you're making up for some of it in investment return, but we're expecting to pay out more in benefit payments than you're actively putting into the plan. Any questions on how the assets are moving?
No, I have a question on when you mentioned 20% the gain on the loss is recognized. Does that mean you filtered out 5 years and recognized for one particular calendar year 20%, and then you recognize the other 20% in each of the successive?
No. So we stand at January 1st, 2021, and we take 20% of the gain between 2020 to 2021. Only 20% of it is recognized. Right. The gain from 19 to 20, 40% of that is recognized. The loss from 18 to 19, 60% of that is recognized, and then continue to go backwards. So each year we're recognizing an additional 20% of the preceding years.
That's what I was saying. You go out 5 years, 20% of whatever you had in that year, right?
Yep.
Okay. No, I can see the Excel sheet here.
So that's what we've seen in the last 5 years, but then we have to look forward to the future. And I'm going to talk a lot about the investments here, but Chris is actually the one that's going to talk much more about the investments. And while I put on my actuarial hat and talk about expected rate of return, he's the one that's really guiding the expected rate of return. I'm just looking at it from an actuarial perspective.
Okay.
So caveating. What I'm looking at here is a slight interpretation of the efficient frontier. On the y-axis, we have expected nominal geometric rates of return, and on the x-axis, we have risk and volatility. As expected, U.S. core fixed income is on the lower end of risk volatility and the expected rate of return. And then when you go out farther to the right, global REITs are at the farthest end. This is a representation of your current investment portfolio. So overall, balancing it out, your entire portfolio sits right in the middle of core fixed income and those riskier assets. we look at it over time and say, okay, we know that there is a very wide range of potential rates of return, especially in a shorter time horizon. 5 years, very wide range. Just like we see in a single year, it might be -7%, it might be plus 19%. So in a 5-year period, it's a much wider range. And then as we look over a longer time horizon, and what we're looking at for you is currently a 50-year time horizon, we're trying to narrow in on what's the expected remaining lifetime of your pension plan. So what do we expect the rate of return to be over the entire period of the plan? And then we go to the middle, we go to the 50th percentile, because we want a decent chance that you're going to outperform the expected rate of return. We want to have some conservatism built into the expected rate of return. And based on this analysis, which again is more actuarial than investment in nature, we're looking at a 5.90% expected rate of return. You are currently assuming 6.25%, which that is a difference. That's 35 basis points difference. However, this is if you were purely investing in index funds and did not have an investment advisor helping you in choosing the best funds for you to help potentially outperform the market. So from an actuarial perspective for this year, I'm still very comfortable with maintaining the 6.25% rate of return. I'm not suggesting lowering it, although I do discuss this with the pension board every year, and you guys do take very conservative positions, and I greatly respect that and encourage it, because actuaries should encourage conservatism, but you are definitely at more of the forefront, especially in the state of Connecticut, in keeping a lower rate of return and being more conservative, especially due to the small active population left in your pension plan. But I think, especially for now, we can maintain the 6.25% rate of return. We'll keep an eye on it, see if future expectations end up lowering further. It's kind of depressing, actually, to talk with a lot of the investment people year over year, because they keep having more pessimistic outlooks. And then I say, but look how great the market did last year. And really guess that that's not actually indicative of future performance. Long story short, I think we should stay at the 6.25%. But of course, Chris is going to talk more about the investments as well.
While we're on,
Michelle?
since you asked the question, mentioned that, Michelle, since you commented that we are conservative, and that's fine, it's not my job, that's the pension board's job. But you did suggest that in your head there was a quantification how conservative that is in the state of Connecticut, because you mentioned other towns, and the sense I got,
And
you had a number, or you had a quantification of that comment.
And so the difficulty here is everybody always compares with their neighbor. Everybody, you cannot help it. You always compare with your neighbor. You always compare with the state. And mostly everyone in the state is finally just now getting below 7%, getting 2 or getting just below 7%. So the fact that you're approaching 6 means that you're at the head of the class in approaching that. However, a lot of those other communities have a greater active population, which means they have a longer lifetime left of the pension plan. So when you're looking at a longer investment horizon, you can afford to have slightly riskier investments. They might be invested in more risky assets as well. But we tend to look at a longer investment horizon for those other populations. So it's difficult to compare, but I can confidently state you're on the conservative end, but I think it's proper based on the makeup of your pension plan.
Thank you.
Did I hear another question?
Yeah, Michelle, this is Eric. Maybe if you could just comment on, what your recommendation and what the pension board has adopted over, let's say, the last 5 or 6 years, and where we were, and the process that we had of reducing that expectation, and ultimately what happens if you have an expectation that ends up just too high relative to what your assets end up earning.
So I believe every year of the last either 3 or 4 years, I didn't look it up to confirm, but just about every year in the last 3 or 4 years, you've reduced your discount rate by 25 basis points. even when I've said you don't necessarily have to, especially last year, we introduced new mortality tables. So the Society of Actuaries did the first of its kind, studied specifically public plan mortality. And in studying specifically public plan mortality, found that most public plan participants actually do live longer than the general corporate population. So in studying that mortality and adopting that those mortality tables, it actually increased your liability. But at the same time, you still continue to lower your discount rate to be more conservative. So you have stayed with what I would recommend as conservative assumptions, reasonable assumptions every year. Last year, you actually did elect to not jump fully to the end goal of adopting the public plan mortality table and the discount rate reduction. You actually phased in the actuarially determined contribution, which you're going to see a little bit better when we look at the last slide and we look at how your contributions were developed. But yes, every year you are reduced your discount rate.
And we're well aware, by the way, Michelle, that the impact of that on our budget and the increased contributions, that's inherent when you do that.
And the other question that Eric asked me the other issue that Eric asked me to address, though, was what are the consequences if you don't lower the discount rate? And the consequence is if you regularly underperform the expectation, like if you stayed at 7%, but we know that over the lifetime of the plan, you're going to earn 6%. What's going to happen is you will need to make additional contributions in the future because you will not make that investment return. It just won't happen. And so pension plans are always the question of pay me now or pay me later. If you're able to put in the funds now and invest them better upfront, then it gives you more time to earn an investment return on it, which especially in these good years, it's wonderful to have the additional investment return on it. But if we're expecting too high of a rate of return, especially when municipalities were assuming 8%, which was great in the 80s, and then we stopped hitting that for a very long time, you end up in terrible funded situations where you're having to make additional contributions because even if the investment return doesn't materialize, you've made these pension promises. You are cutting this 1.9 million in benefit payments. You're making the monthly checks. And so being slightly more conservative in the investment rate of return gives you the opportunity to outperform that investment return versus underperform and have to make additional contributions in the future when you no longer have active employees left. Did that cover?
Yeah, thank you, Michelle.
Wonderful. So let's bring it all together and look at your liabilities year over year. So as discussed, when we've lowered the discount rate year over year, and especially between 2019 and 2020, when we both lowered the discount rate and increased the mortality table, your liability has slightly grown year over year. But now we're looking at between 2020 and 2021, what happened? It looks like nothing happened, 32.8 to 32.7. And it's not that actually nothing happened because we know 2 of your employees retired and 1 of your employees passed away. But in the end, it actually almost offset. Generally, we actually expect your liability to grow from year to year. And that's because it will increase for just the time value of money. We're rolling forward 1 year, so we would expect it to grow by 6.25. It decreases by benefit payments being paid out. And it also increases for normal cost. Normal cost is 1 year's accrual by your active employees. So we typically would expect your accrued liability to grow and not just stay approximately stable. What we actually expected was for your liability to be at 33.0. So a slight $300,000 gain in what we expected, which is good news. We like good news. We like gains. When we look at this middle section, this is accrued liability by member group, and this is similar colors to the first page with your population. You can see your terminated members is almost non-existent. It's at 0 when we round. And that's just because there's only 1 employee who's not owed a significant level of benefit, so it's just very small relative to the others. It's rounding to 0. Your members in pay status is your largest chunk, and it's been growing year over year. We're now at 29.3. and your active population is just slowly shifting over from active to the members and pay status. But the most important part to look at is actually how your unfunded accrued liability has changed year over year. And so, like we talked about, it has grown as your discount rate has been lowered and then introducing the new mortality tables. But look at this significant decrease from 2020 to 2021, $1.2 million lower than the previous year. This is fantastic, which translates over to the funded ratio also improving from 52.4% to 55.9%. So we've had some headwinds pushing against us here as we've changed the assumptions and become more conservative. But now we're staying in a conservatism and your funded status is improving. This translates over into your actuarially determined contribution.
Michelle, it's PJ Shanley again. Can I jump in with another question?
Sure, I'll scroll back up.
Specifically, the 52.4% and how that's dropped, and now we're back up to 55.9. How do you see that relative to other communities, like you just said, comparing to our neighbors? You know, I think when I first started, this is my 8th year, we were in the 70s, mid to high 70s. Mm-hmm. And I understand there's certain factors that come into play here, but being in the mid 50s, low 50s, at what point do we need to start ringing bells and, ringing alarms here?
So I don't think that you're at the ringing alarms because of what we talked about with the conservatism and the assumptions, where, again, a lot of times if you compare with your neighbors, they're probably assuming too high of a rate of return. And I'm probably having discussions with them every year saying, please, let's lower this to a more reasonable expectation. If instead we were looking at it went from 52.4% and then we're not saying make any changes this year and now it's down to 48% or 46%, then I would have concerns. If you were having difficulties making your actuarially determined contribution, I would have concerns. If you decided you don't like how I'm calculating the contribution and you want to switch over to a 20-year open amortization, then I would have concerns. But when we look at how I calculate your contribution, it's over now a 10-year closed period. So what that means, if all the assumptions are met in 10 years, this will be 100%. That's just the beauty of how contributions work. We're intending for you to pay off that unfunded amount over the next 10 years. So as long as you're not having difficulties meeting the contribution requirements, this isn't the time to ring panic bells. If we get 2 years from now and there's significant market crashes and your people aren't dying, because I can't be an actuary and not make a joke about people dying, then I would have concerns. But I think just based on where it is, yes, it's scary to see that it's gone from the 70s to the 50s, but you have to keep in the back of your mind that you're being conservative, you're making the appropriate steps. And so keep on the path and have faith in it.
Okay. Perfect. Thank you.
I'd like to jump in just this point, since we have covered this with Michelle Lasso when we had our earlier version of the town budget. At that point in time, they had a different cutoff, so they were using maybe a 6 months different data than what we're seeing here, Michelle. But what I did is, since we had talked about what happens when you change the number that you've quoted, 6.25, and we did a sensitivity analysis. What was 5.25? What was 7.25? And what does it done to that exact percentage? And here's what it does. It increases, if you go from 6.25, it increases it over 10 percentage points. So I would just like ourselves, maybe even people at home, to know that if you had 7.25 there, not that I'm encouraging it, but certainly back when we had a higher percentage, I believe we had a higher rate, that it wouldn't be declining at all. In fact, it might even be higher than what you see on the left here number, 64. What's that, 65.4?
65.4. Mm-hmm.
Because it goes up 10 points. Did the math itself for them, for Michelle, and now I'm sharing it with you.
Any other questions? So it translates over to your actuarially determined contribution. And just as the funded ratio has moved around and liability has gone up, your actuarially determined contribution has also increased from year to year. And this is where it actually becomes a little important, where if we did say we went back in time and it stayed at 7.25, then I think your funded ratio would still be in an interesting position because you wouldn't have been contributing 1 million, then 1.2, then 1.5, and then 1.8. You'd be contributing at a lower rate as well. So there's a trade-off. I don't think your assets would be quite as high if we had stayed back at the 7.25. So it's difficult and it's painful, but I think you're making the strong and important steps to help improve the funded ratio.
When you say determined contributions, is that the term, the contributions in that 3-word?
So
Is that from the town? Is that from the a combination of returns and what the town could help me?
So actuarially determined contribution is what the Governmental Accounting Standards Board has termed the contribution that an actuary calculates for a town. So it's based on a formula, and I will actually walk through the details of it on the next page so that you can see a little bit how the contribution actually is developed.
Okay,
But it has not, the town is not setting this. We calculate it based on the methodology that is established, and then that is the contribution to be made.
Okay, I'll look for that calculation.
I can show you a little bit of the pieces that will go into the numbers, but there are 3 components to your actuarially determined contribution. The first component is that normal cost that I mentioned. It's the expected 1-year accrual that for your active employees, plus a small component for administrative expenses. You're paying out administrative expenses in the next year, so we include an expectation of what those next year administrative expenses are going to be, just so that you're paying it out of the trust fund and then you're contributing it in.
Okay, I'm seeing words that just define what interest means.
I'm going to get there.
Oh, okay.
Sorry, I'm working bottom up.
Okay. So you just defined normal cost?
Correct. I just defined normal cost.
Why don't you define normal cost is what goes,
Normal cost is the 1-year accrual for the next year. It is what your active employees are expected to accrue in the next year because they worked 1 more year of service. Their pay has gone up a little bit. So we expect them to have a slightly higher liability because they remained active in the next year.
so it's what they put into the plan.
It's actually reduced by what they put into the plan. So they're contributing a portion of it with their employee contributions, but they are accruing a benefit that is slightly higher than what they're contributing. So it is the cost to the town of them working 1 more year. Past service cost is an amortization amount of the unfunded accrued liability. It's called past because it's from everything in the past that's happened. So it's when we've made assumption changes. It's when markets have performed differently than expected. It's when people have behaved differently than expected because they retired when we didn't expect them to, or they earned more money, or they didn't earn more money. They became disabled. It's just everything from the past being amortized over a 10-year period now. We take those 2 components together, normal cost plus past service cost, and we add interest on it because we're calculating all of these numbers as of January 1st. So in this case, we're calculating as of January 1st, 2021. However, you're not making that contribution on January 1st, 2021. It's actually for the fiscal year, July 1, 2022 to June 30, 2023. We're calculating it so far in advance to allow for the budgeting process so that you're able to account for this is what we're going to be making in the next year. This is the required contribution. Let's make it. And so because we're calculating it as of January 1, 2021, and it's not being paid until 18 to 24 months later, we're adding on interest to it. And so that's just at the current assumed rate of return, 6.25%.
Okay, so you're taking some amount, some number, and multiplying it by 6.25%?
multiplying it by 1.0625 squared minus 1. It's 2 years of interest on the 1.619517 and the 70,978.
Okay, so A plus B, then multiply it by 6.25 twice, and then, okay, got it. And that will give you your interest. Thank you.
Yes.
Very, very good mathematical explanation. Appreciate it.
I felt like you wanted the math.
I definitely want the math. What do you to understand what you do? I mean, you know, I'm going to ask what I, you know.
And
This is the point where the 4 people at home fall asleep.
Good. And then that's probably why they're not on the Board of Finance. I mean, I feel it's my responsibility, since you're here tonight, presenting information. So please don't take it anything other than this. I want to understand here. And maybe I'm not an A student. I'll accept that. But that's what I'm here for.
No problem. And the one difference on this page, you'll notice this purple bar here. That's what I was talking about before, that there was a phase in for the January 1, 2020 valuation when we started reflecting the updated mortality table. The budgeted contribution is not the full 1.9 million. It's actually smoothed in, phased in from the 1.5 to the 1.9. So let's now get to really when everybody falls asleep, because it's a page of just numbers. So we start at the top. The left-hand column is your final results from January 1, 2020. The right-hand column is the baseline results for January 1, 2021. We call it the baseline results because just in case you wanted to look at another assumption change, this is our baseline. 0 changes from 1/1/2020 to 1/1/2021, except what did your assets do? What did your people do? So 6.25% interest rate, that's what we've talked about. The base mortality is the Pub 2010 public safety mortality table. We use public safety for the police officers. There is a general table that is used for the town employees. And then we talk about mortality projection, generational MP ultimate scale. This sounds like utter gibberish. What it means is that we know, we actuaries, I'm gonna use the royal we there, we know that your life expectation today is different from your life expectation tomorrow and the next year and the next year. We know that just by surviving another year, there's going to be significant improvements in research, medical technology, availability of medicine. And so it tends to be that your mortality isn't stagnant. It's going to actually keep changing year over year. And so we can't just use this one single mortality table anymore. We have to project it forward and expect that, okay, if you survive this year, you're going to be in even better shape next year. So maybe today we expect you to live to 82.7. And then next year, we actually expect you to live to 82.9. I'm completely making up those numbers. Those are for example. But that's how generational mortality works, is we're projecting out that you're going to have better life expectancy in the future. And generational is a specific term, meaning that if we bucket groups of people, groups of population together, for example, the baby boomers, or Generation X, Generation Z, et cetera, the millennials, you actually tend to have these cohorts whose mortality develops together at different rates, depending on which cohort you're in. So that's all the generational means. Lots of very exciting actuarial mortality terms. Actuaries love this stuff. We study the heck out of it. Most people don't understand why we care. But it's very important, and it's our intention to try to best predict the future. Because for a pension plan, once people have retired, the only significant change is when are they going to die? How much longer are you paying these pension payments? We have to try to project that into the future. And so that's what we're doing here, is projecting out that mortality. We talked about the liability, how it changed from year to year, 32.8. It's now 32.7. Your actuarial value of assets increased significantly from 17.2 to 18.3, which is why your unfunded accrued liability decreased so significantly and your funded ratio increased. The next little section talks about amortization and the past service costs. So I said on the previous slide that this is how we're paying off your unfunded accrued liability. This is the accumulation of past events being different from expected, contributions different from expected, investment return different from expected, people behaving differently than expected. So you want to pay that off over time. You're not going to just throw in 14.4 million this year. That's expensive. But you can pay off 1.6 million this year and 1.6 million next year to pay it off over time. And the way you've been paying it off over time was you set a fixed amortization period a number of years ago. And now we got down to 11 years last year, and now it's down to 10 years. And what you'll find when we actually talk about the town plan is they've also gotten down to 10 years. They actually got down to 10 years 2 years ago. And they've changed over. So we're not going down now to 9 years and then 8 years and 7 years, because what's going to happen is if we have significant swings in any given year, recognizing that entire 15 million over a 5-year period, say, would be very expensive. And so what we're doing on the town side is something called layered amortization bases. Tuck that in the back of your head, because I'll talk about that more when we get over to the town side and what that means and why it's different. For the police plan, just know we're looking at paying off this past service cost, the unfunded accrued liability, over 10 years, and we're looking at 1.6 million for this year's portion of that payment. So then we get into the normal cost, and it's calculated as, first we take how much the liability is expected to increase for your active employees in the next year. Last year it was 110,000, now we're down to 64,000. Remember, our population decreased from 5. Similarly, your expected employee contributions have decreased. This is offsetting the accrual. So this is the portion that your employees are paying towards that additional benefit they've accrued. And then we have a component for expected expenses. Just simply, you're paying administrative expenses out of the plan. It's effectively a 1-year service cost. And so you want to pay that back through your contribution. Take the total normal cost, subtract out expected employee contributions, add in the expected expenses, and you get to your net normal cost. Last year it was 101,000. This year we're at 71,000. Sum the two pieces, the past service cost plus the net normal cost, then apply interest to it, 2 years of interest to it. And we get to the bottom line of your actually determined contribution. There was a phase-in last year, like I talked about. There is no phase-in this year.
Michelle.
Mm-hmm.
Run through that numerical paragraph, I'll call it total normal cost. Just do the math again, would you?
Sure. So we start with the total normal cost. That is an active employee's expected 1-year accrual. So how much of liability increase they're going to get because they worked 1 more year. But if they work that 1 more year, they're also making contributions to the plan. They're required to make contributions to the plan. So that reduces the total normal cost that the plan, that the town is responsible for. So they're accruing a total benefit and the town needs to fund that, but not all of it because they're funding a portion of that. So that's where we do 64 minus 15.
Got it.
Then the third line is just expected expenses. You pay administrative expenses from your plan. So part of that is just having a trust fund, cutting pension checks, paying me, not me specifically, but Milliman, attorney involvement, all these things that contribute to expected expenses for the plan.
All right, thank you.
Add that in. And that is the end of the police plan's information. I can pause and take additional questions, or we can move over to the town.
Town sounds good.
All right. So remember, the town is very similar to the police, but of course has slightly different details. So I will go through some of it a little bit faster, especially when we get to some of the asset return information, because it's very much the same as the police plan. Same thing happening with the town that was happening on the police. You have a closed population, so your active group is slowly decreasing over time. started in 2017 at 11. Now we're down to 4. Your terminated members, remember, those are people no longer actively employed. They are due a benefit in the future. They are not currently collecting it, but they will be collecting it in the future. So the purple section on top, it's staying relatively stable, slight decrease. And actually here, your golden section, the members in pay status, it's stayed relatively stable as well. And this is because where the town differs from the police, your police officers, like I said, can generally retire at slightly younger ages. Your town employees need to be generally 62 with 25 years of service or age 65. And so they are typically retiring at slightly more elevated ages, meaning that their life expectancy is going to be slightly shorter. Their retirement life expectancy is slightly shorter. So you don't have as longer termed retirees as you do on the police plan. So there's not as much of a ballooning out of the members in pay status as you saw on the police side.
Michelle, I just want to, I think you touched on this last time, but the members in pay status could be an actual member or a surviving beneficiary, correct? Okay.
Correct.
Thank you.
So in the last year, 2 active employees retired. 1 active employee passed away and a lump sum was paid out. Just a return of contributions when a lump sum is paid out. You're not taking the entire accrual of a pension benefit. It's they received a return of the contributions that they paid to the plan. One of your terminated members actually became disabled. And you'll notice that, oh, but wait, 4 and 4, that number didn't change. How did we lose somebody or how did we gain somebody? Well, that disabled person also has an alternate payee because they got divorced and they're due a benefit in the future. So we managed to change 1 person into 2 people. Actuarial magic. It happens sometimes. And then 2 of your retirees passed away. So overall, population staying kind of stable, slightly shrinking. Your active population on the town side is almost actually more boring than it was on the police side. As you can see, almost everybody already has over 30 years of service and is in the age 60 to 64 bracket. And like I said before, in general, the normal retirement age is 62 with 25 years of service or age 65. When we look at the 4 active employees left, almost every one of them is currently eligible for normal retirement. And in fact, I think the last normal retirement date for these 4 employees is in 2022. So we are very, very close again to every one of your active employees being eligible to retire immediately with an unreduced benefit.
That story you told earlier, Michelle, is that related to why the disabled retiree of 1 has such a significant increase in the average annual benefit compared to the others?
So this disabled retiree he was a terminated vested member. You actually did not have any disabled retirees previously. He was a very unique situation, and just a portion of his benefit is due to his ex-wife, is required to be paid per the wonderful courts to his ex-wife.
No, I heard that, but I don't understand how come it's almost double of the other ones. Significantly higher, or maybe not double.
Oh, the average benefit.
Right.
I do not know off the top of my head.
Fine, that's it. You do not know. That's good.
Yeah, I do. I don't remember why his benefit is significantly higher than the others.
Roger that.
Any other questions before we move on? Great. The asset results, very, very similar to the police. Up and down, you're invested the same. So it's just a matter of timing and the level of benefit payments that contributes to slightly different performance rates between police and town. In the last year, you paid out 1.1 million in benefit payments and made $500,000 in contributions. So this is even a more significant difference between money going out and money coming in the townside pension plan. Also, the level of the assets is significantly different, and you'll see the level of liabilities is significantly different from what we see on the police plan. But otherwise, the information is exactly the same. We have a gap now where the market value is greater than the actuarial value because of those deferred gains being recognized over time. This is the exact same information that we walked through on the police side, so I'm going to skip right through it. So we can get to the really fun stuff and look at the liability numbers over time. It's been a lot more stable on the town side plan than on the police side. And it more has to do with just the scale of the liability and also the relative age of the employees and retirees. So remember, the police plan is relatively younger. Their population is relatively younger. And so longer lifetimes remaining on the police plan as compared with the town plan. So if we actually look back here at your average age, the average age of your town retirees is 80.1. Average age of the beneficiary is 81.2. If we look back at the police, 63.7, 63.1, 20 years difference. So what happens on the town side that's helping to mitigate some of those significant liability increases is that people are just simply passing away because it's an older population. So it's not that there's something significantly different happening on the town side than the police side. It's just a very different population. So that's why you're not seeing the quite as significant jump ups. And instead of your liability staying flat, it actually decreased a little bit from 2020 to 2021. You can also see, going over time, your terminated member liability, a slight sliver, but it's not rounding down to zero. We're actually at 0.2 left over in the terminated population. Your members in pay status, does continue to grow as your active population is shifting over to being in pay status. Your unfunded accrued liability has decreased from 3.9 to 3.6. and have a similar increase in your funded ratio from 65.9 to 68.1. So on the town side, you do have a slightly higher funded ratio, but again, this is more reflective of just the general level of the liabilities and assets, where it is a smaller liability and asset on the police side, and they're generally an older population. And so you're seeing a little bit more of mortality gains happening on the town side than you do on the police side. That translates into an actuarially determined contribution. Again, a smaller level than we see on the police side, but very, very similar information. The normal cost is developed in the same exact way. Past service costs developed in a very similar way. And we did have a phase-in last year for reflecting the new mortality table. And this was more significant because while on the police side, we reflected public safety mortality, on the town side, we're reflecting a general population mortality, and that's slightly higher life expectancies than we see in public safety because they have just different stressors from the job. So then we get to the bottom line numbers again, very similar presentation to what we walked through on the police side. Accrued liability has decreased. Your actuarial value of assets stayed almost exactly the same, almost slightly higher. And remember, there are deferred gains that are not being reflected in here yet. But then that means your unfunded accrued liability has decreased significantly, and now your funded ratio has improved as well. So like I said, the amortization period is different on the town side than on the police side. What we're doing here is saying, okay, we started in 2019 with a 10-year amortization. And just like, so when we think about these amortizations, we actuaries like to usually talk about having a mortgage. So we have our regular mortgage. Let's say we had a 10-year mortgage in 2019, and then we wanted to remodel our kitchen. And so we took out a home equity loan for another 10-year period. That's going to be another $10,000. But we still have our original mortgage that's now going to be paid off over 9 years, plus this new home equity line of credit that we're going to pay off over 10 years. And each of those is going to be paid off over the remaining period. And then the next year, we're going to do a bathroom remodel because we're just not tired yet of fixing up our house. And that'll be a new 10-year amortization period. So that's what layered means. It means that every year that there is a change, and a change meaning we've changed assumptions, or there's been experience different from expected, or assets have performed differently than expected, that is a change that we are going to carve out and amortize on its own as a new little 10-year period to be paid off. So that's what's getting built into this past service cost year, is a few different layered pieces. Then we walk through the normal cost, exact same as the police plan. We start off with total accrual for the next year for your active employees, much smaller scale for the town employees, especially because given they're approaching their normal retirement ages, we generally are expecting most of them to retire and not keep accruing in the next year. So most of your normal cost on the town side is now just expected expenses. Step down, total everything together, add 2 years of interest, and we arrive at almost a flat actually determined contribution again, ignoring the phase-in, of course. Any questions? Okay. Hearing none, I will stop sharing my screen then. And say thank you very much.
Thank you very much. It was very thorough and helpful. Great. So now then, let's go to item number 5 and the presentation by Chris Kashmar. I pronounced it correctly.
You did.
Sorry.
Perfect.
Okay, thank you.
Good evening, folks. I'll do the same that Joe did here, and I trust folks can see the deck okay, the cover page. And we'll be quick to the punch here and kind of catch up on the highlights and share with you what we do and how we interact with the town's pension board. As Michelle alluded to, we focus most of our efforts on, there's a pile of money that the town's accumulated to support your liabilities, and what do we do in term from an investment perspective. So we're certainly well engaged with the Milliman folks quarter to quarter and year to year on trends and the like, and work to build those considerations into the investment programs. But I'll step back just for a minute or two here and catch up on who we are and kind of how we function, and then we'll dive into a couple of data points around the allocation of the assets and some performance for the two pension plans. Bear with me here for just a second. As hinted at, we did rebrand ourselves about 6-7 weeks ago now. For a long time, we had worked with the town and were known as Fiduciary Investment Advisors. We merged with a peer firm in Chicago 16-17 months ago under the banner of DeMayo Schneider, and have made great progress in integrating the two organizations, and thought it was an opportune time to rebrand the combined group. So we'll be Fiducian Advisors for the extended foreseeable future, I suspect. We oversee nationally about $225 billion of assets for institutional investors like yourselves, and I'll share some of those details momentarily with you as we work our way through the collateral. Certainly, I'd take the opportunity. I'd be remiss if I didn't. We've worked with the town for a long, long time, and Eric and Barbara and Mitch and others know that we're very transparent. We try to be kind of very logical in our approach and straightforward. And I think the town's enjoyed some nice returns over the years, and we certainly thank you for the trust and confidence through our history together. I mentioned earlier just the combined organization and what it is. So certainly defined benefit plans and municipal defined benefit plans at that are a big focus for our organization. But you do see we have a diversified footprint in terms of the types of asset pools that we work with. So beyond municipal plans, defined contribution plans and endowments and foundations, and we do have a private client group as well. About 180 individuals work at the firm today. Again, dual headquartered in Chicago and in Hartford, and then with some satellite branches elsewhere across the country. I'll go from there. Let's see here. About $17 billion of pension assets that we work with nationally, and that works across 130 or so distinct clients. And I would say, let me just step back. I would say, just following on what Michelle had mentioned, just in terms of credentialing in Connecticut, we work with about 40 of your peer towns and communities today. And we also have a number of other clients, municipal clients in Massachusetts and Rhode Island and the like. So we've been in this arena now for the better part of 30 years, operating in Connecticut, and put a lot of resources and time and attention to that effort. So let's switch gears just for a minute. So typically what we do with the pension board that we meet quarterly with is we'll spend a bit of time just on goings on in the markets. And if you were to stay with us for the second portion of the meeting, you'd see a lot more detail and numbers and analytics. I've just kind of picked out a couple of select pages here to share with you. And we use these type of bigger picture themes just to inform a conversation with the board around what's going on in markets. How are the different investment managers that we're using in the program positioned? Did they have productive quarters? Did they not have productive quarters, and why? Are there changes we need to make either to the larger asset allocation structure that Michelle made reference to? Are there changes we need to make perhaps to the roster of investment managers? And on occasion, we'll work with the pension board and we may need to replace a manager if our research team has lost conviction in them. So we'll work you through some of that detail momentarily. Here's the big picture, right? And what we're going to talk about when we convene with the pension board in a little bit of time here. Markets have been remarkably resilient, I think, as all you all well know, over the last year or so. And when you see some of the numbers in a minute, it would have been hard pressed to think back at the onset of the pandemic that we'd have the type of returns in capital markets that we've had over the last year. Those returns, as you suspect, have come from a couple of different places, but their predominant source has been just the staggering amount of stimulus that's been injected into the system. So you'll remember back at the onset of the pandemic, we had the CARES Act, which was $2.5 trillion or thereabouts of relief. We had the Fed reducing interest rates to zero and injecting all kinds of liquidity into the markets. As you see here referenced in the upper left-hand corner of the page, as we sit here in the spring of 2021, we've had more fiscal stimulus in the way of the American Rescue Plan Act. And all that stimulus, both monetary and fiscal, has clearly emboldened investors, right? And it's kind of carried the economy back to this kind of emerging recovery, if you will. And now paired with hopefully these gains on the vaccination fronts, the markets are clearly positioned and acting like they expect the economy on a global scale ultimately to reopen fully. And obviously an open and growing economy, all things equal, should be good for equities and to an extent fixed income as well. Other things just in the market that we'll talk to the pension board about this evening, interest rates and inflation expectations as we transition to that period of better sustained economic growth. Somewhat natural, right, to begin to see both of those type of metrics move a bit higher. And you see that, in fact, here in the exhibit we provide in the lower left-hand corner of the page. Probably not problematic to the level that they'll interfere with the recovery ultimately, but something to be mindful of. We talk a lot in the portfolio about the benefit of diversification, but the takeaway from it is you've seen much broader return patterns for capital markets. You remember back right when the market started to recover last spring, they were led by the pandemic resistant stocks, right? The big growth names, the glamour names that, kind of stay-at-home type of stocks that did very, very well. Since then, particularly since November of last year, you've seen other areas of the equity markets around the world do better. Smaller company stocks, value stocks, and the like. That's encouraging to us because historically that has often kind of been on the front end or foreshadowed, a new economic regime. So we think that might be what's going on now. Anyways, that's just a little bit of color and perspective at a very high level in terms of the economy.
Hey, Chris, I've got a question.
Oh, Jim, yes.
The last chart. Am I reading that right? And I don't know which color blue is the right blue, but is the 10-year Treasury the bottom of those two blues on the lower left?
Yeah, it is. Yes. So, right. I think, Jim, what you're looking at is, No, the 10-year Treasury is this green. Yeah. Is it blue in your eyes? It looks like it's kind of greenish.
No. Hey, listen, it's great getting younger, so I'll accept it. The lower one, I should have said that myself. I'll remember that for another time. Thank you, Chris. Now, that's telling me it's gone from 1% to almost 75% higher in the last 2 months. Am I reading that graph right?
You are. There's been a big uptake in interest rates over the last couple of months for sure. So you are absolutely reading it correctly.
And yet I don't see that in the inflation number yet.
Not yet, right? You've started to see more recently those inflation data print a little bit higher.
Yeah.
And I say, Jim, we would, for what it's worth, I think we would share the Fed sentiment, right? They've been suggesting for some time now that we'll see, probably because of some of these just frictions and bottlenecks in the economy and supply chain, see this transitory higher inflation, but then it's likely to settle down a little bit in the coming quarters and months. So you're right. You haven't seen it just yet. Inflation has moved a little bit higher, but not dramatically so.
Well, I wish I was at your meeting when you're discussing the one on the lower right, because I think I was able, other than knowing what G and Y is, or V, whatever it is, I thought it was a great prediction, and it almost explained itself. So good job by that.
Yeah. Just for the group, it is sometimes it's my own fault. I make too many. We live this stuff all day, large caps, small caps, growth, value, U.S., international, developed, and emerging markets.
Excellent graph. Thank you.
Good. So just a little bit of, so what did that mean for markets recently, right? So kind of an interesting first quarter that we'll flesh out with the pension board in a couple of minutes time here. So again, right, we talked about interest rates that had moved higher in Q1, and that was a bit of a dampener for fixed income returns, right? It can be a confusing concept, but for fixed income securities, when interest rates go up, generally bond prices go down. So we did have higher interest rates in the first quarter. So fixed income generally was a little bit negative actually in that January to March period, but equities continued to march along at a fairly decent clip, right? So a large and small company, developed and emerging market equities all moved higher. The idea that the economy's poised to reopen, was beneficial, all things considered, for real assets and the like. And certainly inflation expectations a touch higher played into that too. But a mixed picture, but generally one at the highest level continues to flesh out this idea that The world is expected to be better in 2021, last half of this year for sure, in 2022 than it was over the preceding 15 months. And here's where we cut to the chase, and I think hopefully get to the interesting data for the group. This is the aggregation. Michelle made reference to the town and the police plan. We aggregate the assets for purposes of representation to the pension board. So at market value of those assets at the end of March was just shy of $28 million. You can see the reference Michelle had made moreover to fixed income securities at their target rate, right? Of close to 40% of the program. Domestic and international equities, a little bit of real estate, a little bit of inflation protection. I mentioned earlier a central kind of MO for us when we're working with plans like yours is the importance of diversification. And diversification works at the asset class level, right? We have fixed income and we have particular types of fixed income strategies under the hood. We have large cap equities in the US. We have small cap equities in the US. We have developed market focused managers overseas, and we have dedicated emerging market managers, and we have a small cap overseas. And we have diversifying assets in the form of real estate and inflation. The intent here, right, is that we're trying to stabilize the return stream as best we can, but do that on the margin with a collection of managers that we think over time, with the benefit of a full cycle, can add, they don't have to add a ton over the broad markets, but they can add a little bit consistently over the broad markets. Again, this idea, and you'll see it explicitly in a minute, of an all index concept versus mixing and matching some indexing and some active strategy. So this is the roster of managers that we spend a lot of time with the board each quarter on, and you'd see if you're inclined, there's a lot more detail in our quarterly reports to the pension board on all of these underlying managers and kind of how they've done over the course of the quarter and longer periods, what their portfolios are constituted of, and like, in the interest of time, we're going to skip over some of that detail this evening. What does it all mean from a performance standpoint? So I'd turn your attention here, if you can make it out 2/3 of the way down the page. This is where we track how the portfolio does over various timeframes. And remember, Michelle mentioned to you the idea of actuarial and market returns. These are market returns, right? We're kind of selfishly interested in what's going on in real time. So these are data as of the end of March. You can see for the quarter, the plans were up about 2%. So a positive quarter, but a fairly modest one, all things considered, right? But nothing. We don't get particularly excited about, truncated periods like that. We're much more interested in the enduring, longer dated numbers. Here's what I alluded to earlier, right? Who would have thought a year ago, sitting here with all the challenges we had, that we would come back and report to the pension board for the 1 year period ending in March that the portfolio would be up 39%, which is in fact what you ended up getting net of the manager fees over the last year or so. So pretty stupendous performance. And then we roll out over broader periods, or longer periods, I should say, as well. And you see these annualized numbers, 3, 5, 7, 10, solid, consistent numbers we would suggest and submit to the Board of Finance. And then I mentioned earlier, right, this idea, a net of fees of the managers being able to eke out a little bit more than the broad markets. I think this is familiar land for many of you, but the blended benchmark, think about almost as if you were entirely indexed in the program, right? This would be the type of returns you'd be getting for that allocation makeup that we just talked about back here in terms of the mix of asset classes. But because you've mixed in some active management, and the managers on balance have done a pretty decent job navigating on the margin, you see some better relative numbers and consistent ones at that. And I think one of the things that I think the pension board prides itself on, as do we, is the enduring nature, right, of that outperformance. So that doesn't mean every marking period is perfect, right? I go down to the bottom of the page here. There are periods along the way where the managers may have a year where they lag a little bit. But when you string it all together, they outperform much more than they do not. And it has resulted in what we would submit again as a fairly constructive long-term track record for the pension assets.
Chris, on that chart, if you could go back.
Sure. Sure.
So the trailing performance summary, the second box from the bottom, the trailing performance summary. If I heard
Yes,
you,
sir.
is that from March or April 1st of 2020 to March of this year?
Yes. So the 1 year number would be exactly, Jim, April of 2020 through March 31st of this year.
I have a follow-up question as soon as I get my battery to my computer fixed.
Uh-oh.
Is that your standard year, the way you
Yeah.
put out?
Oh, that's so, well, yeah. So we'll roll these numbers. We'll roll these numbers, Jim, each quarter, right? So when we convene in June, right, we'll have numbers through June. The 1 year number will be July 1st of year through June 30th of this year. And
If
we'll
I
roll
remember
that
right, the bottom of the market was March 20th of last year. Is that correct?
about. Yeah. So you did, right? You captured that this 1 year period does coincide fairly closely, right, with the run up from not the absolute lows, but close to it.
No, I'm just trying to make sure I know
Yep.
what we got here. Thank you.
Yep. No, you're right. You're spot on with that. So that is in an aggregate, a nutshell, kind of the higher level numbers. And then I'll leave you with just to give you a sense, just the work that the pension board does. So again, there are tons of number on this page. It's certainly not our intention to go through all these, but we decipher the portfolio and those consolidated numbers we just look at in a whole host of ways. Here we break down all the individual managers and their track records versus relevant benchmarks, and we draw comparisons versus peers and how they're performing. And we do that across the entirety of the lineup and dig pretty deeply where we need to with the pension board, really understanding these managers, where they're taking risks, and is the town being compensated for the risks that the managers are taking. And that's kind of fundamental to what we do. Just maybe 30 more seconds, and then I'll pause again for questions. I should have started at the beginning. We function on behalf of the pension board as what we call a non-discretionary advisor, right? So we work with the board very carefully, who has the ultimate authority on what should this allocation be. Should we keep this manager or get rid of this manager? Should we tweak the portfolio this way or that way? We come proactively with advice, but the board ultimately votes on that and affirms those decisions before we can take action. So alongside all of this focus that's placed on the pension plans themselves, are kind of full array of services that we render to the board in building investment policy statements. Running asset allocation analyses periodically to look at different mixes of assets, obviously doing the work product you see here that we summarized for you, doing manager due diligence and searches if we have to replace someone. That's all kind of wrapped under our advisory construct, if you will. And we try to serve as a ready resource to the board and to John and Audrey, just day to day in terms of overseeing these assets and make sure that we keep everything on somewhat of an even keel. So
When
with
you, on
that,
this page, Chris, when you say you have a asset allocation and target allocation, is that code for you're recommending you change it?
yeah, no. So what happens here, the asset allocation column, Jim, is just a byproduct of market fluctuation,
Roger?
right? So it kind of akin to what Michelle mentioned, right? At a point in time, markets fluctuate at different rates, right? So equities have been doing, as you know, materially better than fixed income. What we didn't show on this page, which it's a good introduction to your question, is what we also do and work with the board on is we will look as we need to raise monies to satisfy pension obligations, right? We did that. When did we do that? We did that back at the end of April, actually, most recently. Where do you think we took money from, right? We're going to take money from the areas that have performed the best, right?
Right.
Because we're trying to work our way back to these kind of basic target allocations, which is what we ratified as the working combination of asset classes. So we actually, back in the end of April, took $500,000 out of the equity portions of the program, and we put that back up in here to the short-term bucket, right? And this is the pool that we kind of use to fund near-term obligations of the plan, predominantly the pension payments that you're making every month. So there's kind of this natural rebalancing and discipline, if you will, and mechanism where we're sourcing that liquidity, and all things equal, right? We're going to take it from the winners, right? Because that introduces the discipline of the ultimate allocation that you're beholden to.
So I'm very simplistic in this, and I do not have experience other than mathematical, perhaps. But I'm seeing two columns, one of which the differences were minus, but then I saw our target allocation, which was higher, 38, for example, as opposed to 34. So I was receiving the message here that we want to go from 34 to 38. Am I wrong in that observation?
You're not at all, Jim. And that's in fact what I did a poor job of it, right? But that's what I was just trying to explain. So there will be times across across our engagements with the pension board where these differences will get wide enough where we'll have to actually proactively rebalance the portfolio.
That's fine.
Right.
But what I'm then noticing is that two of them get 1.6 each. So of the four, 3.2 or 80%, right, is in that metropolitan and that western one, right? Yep. So when you get 2 page hence, I'll be asked, I would, and you don't have to answer it, but the types of thoughts I have is, oh, why would we be investing in those two? And so I'd be looking at their most recent performance versus last quarter, not grand. And so, be asking, are we buying at the dip or something like that? You know what I mean?
Yeah, it's a fair question, right? One of the things, so it's a byproduct, right? Fixed income we knew was tough sledding in Q1 because what interest rates did. What I would tell you, right, is when fixed income has a difficult time, right, it's much less in terms of an absolute downdraft than when equities collapse, right?
Oh, roger that, for sure.
And fixed income, in a way, is kind of an anchor to that stability, right? So we know that the absolute returns over time aren't as high as equities, but it does offer that stability attribute, if you will. But anyways, your intuition is spot on, and we are dynamically aware of these fluctuations and are constantly taking actions to address them kind of throughout the course of a year, for example. So let me do this. I'm going to stop sharing as well, unless let me first ask, I suppose, did anyone have any questions on anything that didn't ring true or didn't make sense?
Oh, Chris, this is Eric. Could you go to page 9 of your deck for a second? Yep. Just to, and Jim, this is to address your question from the pension board standpoint. At our quarterly meetings, we tend not to focus on the columns on the left in terms of returns of the quarter to date or the 1 year. And if you look at all the way on the right, how long we've held some of these funds, it's been for extended periods of time. So we try to, as Michelle had mentioned, of looking out longer term, the pension board does try to look at, for managers, what are their returns over 5 and 7 years to see what's happening both in up markets and down markets for both fixed income and equity.
And also comparing to benchmarks, how is everybody else doing in this particular asset class?
That's right, Barbara. And that's a great point, right? So both Eric and Barbara's points certainly ring true. You see a lot of these longer dated numbers, right? These parenthetic numbers are references to peer group. The lower that number, the more competitive the relative performance. And you'll see that most of the strategies are in the top, what we call the top quartile. And certainly, all of them are pretty significantly above peer. You look here through the other equity mandates, your international managers, you see are top ranking. So
Wow.
we have data that we tackle and assess kind of throughout the, throughout varying market environments.
No, I'm noticing now, Dodge and Cox International Stock Fund. They're kind of like LeBron James, been
They've had
well,
look at their Europe Pacific growth right underneath them is your anchor manager there. So
Yeah.
you would look at it in a vacuum here, right? In a vacuum, you'd say, boy, what happened in the first quarter? That's not very good. And the pension board's aware of that. We're aware of that. We'll talk about it a little bit. But to Eric's point and Barbara's point, look on a 3-year, a 5-year, a 7-year, a 10-year. They're pretty darn consistent, right?
Yep.
And
So your focus of your decision-making process is more in the 5 to 10-year columns than anywhere else. That's what you're educating me about.
Correct.
Yeah. Okay, makes sense.
This is Mitch. If I can interject though for 1 second, Jim, if we see something that doesn't look right in the quarter or the year, we're gonna talk about it with Chris because there may be a change in the managers or something else going on now
Sure.
that will outweigh what happened in the last 10 years. And Chris will look into it and make a recommendation whether he feels we should make a change. And when he does, we usually listen to him.
Oh, I appreciate that, Mitch. I'm just trying to find the right balance of understanding of this material, which I very much appreciate the thoughtfulness of the preparation, the patience in answering questions, so that I become this much more aware, I guess. I don't want to, I'm not qualified to be taking over anybody's job as far as the pension board. I just want to understand. So thank you for all of this, for me, anyway.
This is Eric. One other thing, and I don't think, Chris, you mentioned this, but in our relationship, the town's relationship with Fiducian, Chris and his group are what are called fee-only advisors, and their firm is not involved in any revenue sharing with any of the funds or any of the fund families. So the recommendations that we're getting from Chris and his group are truly independent, and there's no influence of that. This is a better recommendation for Fiducian for some reason, as
Right.
opposed to for the town of Orange.
Excellent point.
So Eric, it's PJ Shanley. Since you brought that up, could we talk about the fees and the fees plan, please?
Yeah, so we have PJ. It's actually, well, I think I know them off the top of my head, so I can share them with you. Bear with me. I might be a basis point or two off. The baseline fees for the managers to their target weights is about 50 basis points. I think it's about 48 basis points last time.
48, Chris, yeah.
48. So yeah, help me out, Eric. I don't have ready access to the exhibit. And then
If you want, I have your schedule. So it's the fund managers themselves. This is Chris from your first quarter. It's 48 basis points. Our custodian, which is Wells Fargo, charges another 3 basis points, and Fiducian's fee is 10 basis points. So altogether, all of our costs, when you add all this together, it's 48 and 3 is 51 and 10 is about 61 basis points is the cost to the town of managing the plans.
Okay.
And the numbers, PJ, that we showed are net of those manager fees.
Right.
The numbers.
And, just in case anybody is watching, I'm more concerned about the expense ratio because 48 bips on $27 million is $130,000 in fees. And I think you're doing a fine job managing the portfolio. I really, I don't have any problems with the funds that you picked and how they've performed, but every little bit that we're able to save, obviously, is going to save the town money on a contribution side, which you're well aware of. I'm not speaking to you. I'm just talking to the rest of the board members.
Mm-hmm.
Yep, absolutely. Yep, our litmus test right over time is do those managers actively add net of their fees over time? And the numbers we looked at tonight suggest they do, but you're absolutely right. We are very aware of the fee construct. You see some indexing mixed into your portfolio in a couple of places by design. And we monitor that relationship pretty carefully. So we agree with you. Fees are critically important. We spend a lot of time making sure that any fees that are being borne by the plans are justified.
Right, even if we're able to drop it to 30 basis points, we're saving, $40,000 plus in fees year over year makes a huge difference.
And
As
to
it
that
continues to grow.
point, yeah, to that point, PJ, in Chris's schedule, we've been working with Chris and his group since 2007. And since that time, our returns over benchmark have averaged 30 basis points. So since 2007, for the last almost 14 years, we're averaging 30 basis points over what the benchmark is. So some of that additional, and that's net of cost. So some of that additional cost that we have incurred has actually gotten us a positive return. So it's a balance. We on the pension board look at this all the time, and it's balancing out active versus passive managers, cost, and expected returns to achieve exactly what you're looking at, which is how do we get the best return for the town and for the participants in the plans at the absolute lowest cost that you can get for that.
That's all I have for questions. Is there
I'm good.
follow-up?
I'm good.
Good. Chris, Michelle, thank you for answering my questions. I appreciate it. Mitch, thank you. Eric, thank you.
Thanks, folks.
Rebecca.
Before we adjourn this part of your meeting, Kevin and everyone else, I know this meeting's been a long time coming. You've asked for us to get together like this. I just want to make sure that before we leave, that what was presented tonight was what you were expecting, and if there's anything more you need from the pension board to satisfy your needs for your request for information and developing the budget each year.
I mean, from my standpoint, I think this was terrific. I think it gave us a good understanding of Michelle's presentation with the actuarial standpoint. I thought it was tremendously insightful. And then Chris did a great job as well on the fund side. Personally, I think that was very beneficial for us.
I think it was great, and your board probably doesn't get the recognition they deserve for the work and your efforts and your due diligence on this topic. But I think the town owes you and Eric and Rebecca and Barbara some their gratitude, because you do have a fantastic board who is very diligent, and we appreciate that.
Thank you, Kevin. It's well received. Thank you.
Thank you all.
Well, if there's no other questions from the pension board side, I'll entertain a motion to adjourn our meeting for 10 minutes so that we can then re-adjourn to our separate meeting.
So Kevin, we're going to stay on this Zoom call, and Eric, you're going to create your own Zoom call. Is that?
That's correct.
That's okay. I wasn't sure, to be honest with you.
Eric, do you need a second?
I do need a second, Barbara.
You got a second.
Thank you.
Thanks, everybody.
Okay, this is Paul with the IT group. That second meeting for the pension board only with the second link in the email, and that is ready for you folks to join. So you will exit this meeting, bottom right-hand corner, you'll hit leave, and then you can click on the other link and join separately. And again, Kevin, as you mentioned, the finance group will stay on this meeting. Thank you all.
Okay,
Eric,
Thank you.
Thank you.
Thanks, everybody.
Thank you.
take care, guys.
Thank you.
Eric,
Hey, folks.
Eric,
Yep,
Audrey will be joining you since I can't be in two places.
okay, no
All
problem.
right. I'll be in the next room though, if you need me.
Okay, thanks, John.
Thank
You're
you.
welcome.
Thanks, Eric.
Thanks, Eric. Thanks, everyone.
We're going to take a break, Kev, or what are we going to do?
Sure, we want to, it's on here to take a 10-minute recess, but I think 5 is probably enough.
Beautiful. Thank you.
Thank you. All right, we're back. And before we go to item 7, I'm not the most eloquent speaker, but like I've always said, I think our board is great and work well together and great backgrounds. But the pension board, that's a great group of people, and I'm glad they're the ones monitoring it. That they really are. So I'll leave that, and we'll go on to item number 7, Amity update. Mr. Nuzzo.
Good evening, everyone. All right, so the Amity update, we have Fiducian is our advisor as well. And their performance is actually very similar to the towns. So the Amity pension has this $16.7 million total under management. The 1-year trailing average was almost 40%. And the 1-year calendar performance was 15%. Very close to what the returns were for the town. OPEB was $3.1 million. And the return on the OPEB was 38 for the 1-year trailing and 14% for the calendar year. So again, another strong performing year. And then the second severance was just under $800,000 under management. The trailing performance was 29%, and the calendar year was 14%. So again, very good numbers over the last year. A couple of other major items that we discussed at the meeting last week. And I know, Jim, you're not sharing any screens tonight. And unfortunately, I didn't have mine to share, but we could talk about it. I think we've seen this information, but we're talking about one-to-one technology for students in grade 7 and 12. The district has secured $57,000 in funding, and the remaining $55,000 is requested from end of the year funds. So they're already spending end of the year money. And we'll talk a little bit about the surplus in a few minutes. So as we said, you always find a way to spend the money before it's even there. So that's a little bit about that. With the one-to-one, need some update on the copiers, Xerox copiers. Upgrades about $143,000 per year, a 5-year lease. What else? That was technology. Little facilities, Amity Middle School Orange in the field. They need some drainage work at a cost of about $43,000. That's going to go to Orange. That's going to go to Sports Turf of Connecticut. And capital non-recurring funds, the high school roof, as we've discussed before, Tremco is going to be awarded the contract for $395,000. And they've requested to waive the bid process since they've handled our roof for many years. This contract is going to restore 22 sections of the roof, scheduled for replacement in 2022, and it will include a 5-year warranty upgrade. And the warranty will have the option to be extended again upon inspection. The health food statement was not really a big deal there. So capital projects, the stadium, there were some change orders to the stadium because of the delay. The state of the fields total, they're going to do some upgrades to electrical work, speakers, cameras, totaling about $43,000. Electrical conduits, $43,000 is total there, and $11,000 was for electrical. They had $11,000 for electrical,
And let's see here. So just some change orders primarily for the delay with COVID for the last year. There was another change order was for about $60,000 on the field projects, and they're going to take it from the bond contingency to athletic projects, do a transfer there. So nothing major there. The HVAC project, $10,000 transfer from the bond contingency as well. So just some extra cost. I know the price of materials has gone up over the last year, as we've all seen and heard. It's coming to fruition here with our projects. So going to the revenue and expenditures spreadsheet, the April forecast surplus is $954,000. And that also includes a $507,000 transfer account, which is the 1%. As we discussed, so it's about $1.5 million heading into the end of April on their surplus. But they couldn't lower their budget as we discussed earlier. It's just going into the same place. So it could be a $2 million surplus again, happening right under our eyes, and as we've seen year after year. So, and primarily coming from the medical account. Looking at the medical account, the current claims for the employees in the medical right now, it's about it's 80.6%, just under 81%. The variance is $900,000, so almost $1 million in the medical account. And it's a good thing that we reduced it, as we've seen before. So it's just the surpluses come and they come and they come, but they're always crying broke for more money and more funding, using end of the year funds for their projects. So that was that on the surplus side. Been talking a little bit about budget transfers of $3,000 or more. We had discussed going back to the technology upgrades for the one-to-one. They're taking that from the medical account, $55,010, transferring it to professional technical services account. And that's the end of the year funds coming from the medical surplus that I just mentioned of 900, transferring it to the professional technical services account to cover the one-to-one technology devices for the students. 784 devices will be purchased with these service contracts. And then the last item we discussed was, that was really it. She gave us a little update on the budget, the bond project update. I think we've seen this before. Nothing really, no surprises here, just some extra expenses and add-ons to the contracts for the turf field primarily. And that was primarily the meeting. Nothing really too exciting was happening at this point for graduation. Are there any questions for me on any of this?
Anyone?
None for me.
Okay.
Oh, Jim's back.
Yeah, I got that ant was flying around my desktop. I gave him a quick burial, Pat, if that's okay.
Okay, that's fine with me.
Hey, well, thank you, Joe.
Thanks, Paul.
What's that?
I said thank you all.
So item number 8, the vice chairman's report. Mr. Leahy.
Yeah, I'll just amplify on what Joe had there, so I'll just share my screen. All right, want to remind all of us, as I share this screen, tell me when you can see it.
Yeah, it's there.
In our budget currently, we have budgeted for $850,000 as a return from Amity, right?
Right.
So Joe has mentioned what happens, the amount of surplus, what is done with that surplus is significant to the taxpayers of Orange in their next year's budget. So that's an intro. The second thing I want to do is just briefly show all of us what I have already shown all of you through an email after I received the materials from the Amity administration. So it looks like I sent this out on May 7th. So it looks like it was the day before or the Friday after the Derby. So probably this is the day I got the materials. Joe, you're correct. As I state here in the second paragraph, the stated surplus is 954. When you add in, as you can see in the yellow there, I hope you can see it, it's 507,844. And that's been placed into the transfer account prior to at least two superintendents prior to the current one, Jen Byers, ago. Sometimes things get put in the transfer account and then they get pulled out, or partially so. And the 1% that you mentioned is up to 1%. It doesn't mean you either do nothing or do 1%. So I just wanted to reinforce that. Regardless, it was not in the budget, so therefore it contributes to the surplus. Joe, you mentioned the medical account, and then I've got into detail here about what at that point in time they had mentioned in their Word document, and I have that open if we need to get to it, it's sitting right here, in terms of what they've said. So when all of you get this Word document, you certainly have it attached in that email I sent you. You can see what they were planning on already spending. I do not know whether the mention of printers, cooling tower repairs, computers, and what you mentioned, Joe, is included in this 185,600. But that again has to go before the elected officials of the Amity Board of Education for either approval or non-approval of those individual items. They were surely not budgeted, and they were at best going to be used from the surplus. Again, going back to the email, therefore, I then explained the second month in a row, I did this calculation to come up with where I believe, and I think the calculation is pretty straightforward, of where they stand in terms of their budget, what they do have done in the past. If you look at the Word document, for example, that they send out, when they eventually get to the point of saying, oh, here's where we are in relation to the end of the year, there is the 900,000 Joe has mentioned. But as you can see, when they start doing the calculation that leads to this 80.6%, they are assuming the entire rest of the year budget. There's only two months left in the year now. But when you earlier, when we had all these surpluses within individual months, the probability is pretty high that the individual months in the future are going to be similar to the ones in the past. And so you don't really have 80.6, you have far less than that. And so what we did in the calculation over here that I sent out to you, and it's in the Excel spreadsheet that I also attached, version 2, V2, what you eventually, the long story short, is you are currently at a $2.1 million, $2,175,089 surplus currently, with 2 months to go. Usually those last 2 months is where in the past we have seen that the budget surplus expands significantly. I think we've all seen that, right? So this is where we are current state. A lot of it is in the medical account, but over the years it has been spread throughout a number of accounts, and that's where we stand. There was a cautionary thing, though, I think that was significant, and that had to do with the final item I'll mention in terms of Amity. And that's another item that's in the Word document. In the last 3 months, as you can see here, their fees for current employees and retirees, the pink that you can see on the document here, has taken a turn not for the better. And so they're almost 100,000. 100,000 is probably buried into that medical account as well. I'm not exactly sure that it is not or it is, but my guess is it is. So they may be $1 million on the one side of that account and then 100,000 to the not so good on the other side. But I anticipate that this is where they are now in terms of the surplus. Again, why is that important? Let's go back. It's important to us because at 50%, or conceivably, we are returned, whatever money is returned to the towns, Orange gets approximately 50%. Since that's our share of the Amity student, therefore the budget that we have to support. So we're expecting 850, which would mean $1.7 million in surplus. So that's important to us. That's important to our budget going forward. And I just wanted to reinforce this material. I know everybody's busy. I know you've seen it. Some of you may have read it in detail, but there's a 5-minute overview of what I saw from last month's Amity's documents. So if you have any questions, or Joe, you want to amplify on the particulars of that Amity stuff, I'd be happy to answer anything that the team has.
Jim, it's Pat. I don't think I was on that list, your email list. PJ got a lot of them.
There's a couple of PJs, you're right.
Yeah, that would be a violation on me, Pat.
Absolutely, yeah.
You are 100% correct. So this is known as the no waiting time.
Okay, so PJ, send me yours, okay?
Yeah, it doesn't do as good a job for me anymore. It used to be when I put in names, common names would come back up. Now I'm getting everybody, but no, Pat, that was not, as you can guess, but I can understand if you're feeling funny.
No, I was just checking because it's been a crazy couple of weeks for me, and
I see it right here. You're not there, and I owe you that, so I will get it to you.
Thank you.
PJ will for sure.
PJ's got 3.
Yeah, I know. PJ, could you share?
Well, Pat, I usually send it to 4 of yours. I don't know what happened.
I know.
A violation for sure.
I will definitely send it.
No, you don't have to send it.
All right, so I'll stop sharing unless there's a question. Going once? Okay, thank you.
Thanks, Jim. Joe, has there been discussion at Amity on the, because they're getting, I believe, in excess of $500,000 from the Stimulus Act of what they're going to do with that? Or will your board, the finance committee, have any say? Because they're doing all these weren't in the budget. We took them out, and now we're going to spend surplus money. But there's a $500,000, I believe, maybe more coming in.
Yeah.
And what's that going to go to?
We haven't discussed that much, Kevin. So I'm not sure if it's allocated for specific uses. But we haven't discussed that really at all in our meetings that I recall.
Because that could end up being another slush fund. And, you know, my feeling is they always, we got this, we used a surplus, this wasn't in the budget. They have that luxury, you know, as we know over all the years, you know, when they've had their big increases, or they say they're not, but they are, with the surpluses, you know, the town or the Orange Board of Ed's the one who gets shorted. And so I think, you know, going forward with whatever they do with this money, it should offset some of the proposed expenditures that they're planning on doing with the surplus, and then having another fund, you know, that they can do with whatever they want. I don't want to sound negative about them, but I you know, we don't have the warm and fuzzies with all these big surpluses every year, and things continue to get done. All right.
So at the end of the day, was our 0.49 increase on the money? Probably was close to it. 0.49 that we voted on for them.
Yeah.
But again, we had to figure it out. I bet it's probably close.
Well, Joe, remember, in every one of the last 10 years, the surplus in that year was greater than the amount increase of the budget.
Yeah.
So anything above 0% Okay?
They don't
Fill in
get
the
that
blanks.
concept.
I mean, you know,
All right.
and I
Thank you,
forwarded
Jim.
it to two of your,
Actually, everybody
You're-
forwarded it to me, so I have about 7 copies now.
well, I'm gonna,
Thank you.
All right, we'll move on to
Change.
item number 9, discuss and approve funding for the Board of Education capital request, $203,780. These are items we talked about when we developed the budget. We just did not take action at that time. John, do you have anything to add on this?
Yeah, whoever makes the motion, it should be to allocate in the capital fund that amount subject to the budget referendum passing on Thursday night.
We have to vote this Thursday?
Yes,
Yeah, wake up a little bit.
you can come in tomorrow and fill out an absentee ballot if you like.
John, which of the documents is this are we talking about now?
The one that starts on the top, Board of Education capital.
Yeah, and we were at Mariel in person when we approved this, removing it from the budget, and
Right.
But we hadn't voted. We didn't vote on it that night.
Right. I just think you should make it subject to approval of the referendum, because if
I agree.
it doesn't pass, I think everything needs to be back on the table.
Mhm.
I agree, and that's why that night at Mariel, I didn't want to vote on it then.
Okay. Well, I can put it up on the screens for everybody if you want. That's your call, but it may make it a little easier. I found it. So there it is. So Kev, I'll let you go back on. There's the items, right, guys?
Yep.
203,780, John?
Yeah. So that, again, like I said, that motion should be to allocate in the capital account the amount of $203,780 for the Board of Education capital, subject to approval of the budget referendum on Thursday, May 20th.
20th.
All good.
So whoever wants to make that motion.
Sure, I'll make it.
Motion by Jim. Is there a second?
I'll second it.
Second by Pat. Any further discussion? All those in favor?
Aye.
Aye. Opposed, abstained, unanimous. Great, thank you. Okay, so the next one is discuss and approve funding for town government capital request of $325,000, which is right below it on Jim's spreadsheet.
Right.
Yeah.
Right there.
Okay, so it should be the same motion to allocate from the capital fund $325,000 for town government capital, subject to the budget referendum passing on Thursday, May 20th.
I'll make that motion.
Motion by Joe. Is there a second?
Oh,
I'll second it again.
Second by Pat. Any further discussion? All those in favor?
Aye.
Aye.
Opposed, abstained, unanimous. Great. Thank you.
okay.
And now, item number 11, discuss and possible action on funding for some capital projects from Ralph Oakenquist's Capital Projects Committee. Oh, Jim's got it up there already. I looked down and it's on my screen. You know, John, on here,
Iron hard here.
just my own question is, I see that the High Plains Community Center tennis courts is crossed off.
Yes, that's been funded in
understand.
a different way.
Okay, so because I had read somewhere or saw somewhere that they were being done this year, and
They're actually under contract, and I believe we're paying for it with LoSiP funds. And the last item on the list for the library, the sofa and chairs, she was able to get a $16,000 grant, so that one's off the list too.
Hey, John, Is there any talk about renovating, because it just came up the other night, renovating the tennis courts at Peck Place?
Tennis courts at Peck Place are in a wetlands, and the recommendation has been not to fix them because they won't last. There is some discussion about putting new tennis courts, another pair of tennis court in, what's that other game, Pat?
Pickleball.
Pickleball.
Right.
Over at Fred Wolf Park down the road.
I think that would be great. You know, I mean,
right now there's some work going in at Fred Wolf Park. They're planting grass and they're putting in irrigation, and the new playground's going to go in over there. And I believe the first selectman would like to put some tennis courts in over there if not this year, next year.
let's do it sooner rather than later. I mean, we have the money.
My suggestion right now would probably be to only do one thing on this list and hold off a little bit on everything else.
Well, tennis courts isn't even on the list, so.
No. My suggestion would be to do the sidewalk repairs at the library and the board ed office, because that's a summer thing that really needs to be done while school's out of session. Everything else you could hold off on. Plus, we're going to be getting some money from the federal government. If we're going to be able to spend it on anything, I don't know. The rules that we're seeing on it are very difficult. So we're all the cities and towns are trying to get some better clarification.
Some just went ahead and put it in their budget. I know Hamden did. I think West Haven did. I know North Haven did. They're using it on current expenditures. We did not do that because we didn't have the proper guidance. And I think, we're more conservative than other towns. And
well, if you read some of the directions, they're going to be paying it back because it says specifically not to put in pensions and not to cut taxes. So, I mean, those are.
You have a certain belief that I am missing.
Well, I know Hamden used it to keep the mill rates flat.
Yeah.
Maybe even lower it.
Yeah.
Like
I don't know. We have a meeting, I think, tomorrow to discuss it. There's 150 pages of questions that have come into the town that the towns have asked, that have gone back to Washington on how you could spend it.
The problem's going to be politically, not us, but like a town like Hamden used it. And I don't think the federal government's going to turn around and say, you're paying us back $28 million. And I bet that's what the thinking has to be, because I got CCM or somebody sent me because of my profession lately, I have not read it, but yeah, it's probably a similar 150-page document to go through on this stuff. And I believe we did the right thing, but I also think these towns are rolling the dice saying, you know what, if we're not supposed to spend it on this, what's going to happen? And can the federal government look at every municipality in the United States? It's impossible.
Right.
Hmm. Along with their other stuff that FEMA does.
Yeah.
Yeah. Hey, I mean, it's so ridiculous right now. I thought maybe we could use it for HVAC repairs, like at the library. I don't see that we could even use it for that. And that's the schools were allowed to do that. Our schools got some money to do that. And we gave the schools money to do that. So.
Correct. Over the summer, we did it. So before the kids went back into,
right,
make sure they were safe.
Right.
And it worked.
Our elementary schools did a very good job over there of keeping the kids in school. I mean, when you look at city of New Haven, those kids didn't go back until March and April. And we were in from day one, except for a few days here and there. I planned week, I think, after Christmas and all.
Yeah, no, they did a phenomenal job. And you look, some of the other cities in New York, they're going back now.
Yeah.
They're going back for 3 weeks.
Mm.
And yeah, that's why, we said it, we told the Board of Ed and, Dr. Scarpetti that they did a tremendous job.
Mm.
Especially, when you look around the country at what other places did, and, it worked out well. So for your recommendation, John, and I don't have it in front of me, as to where this is going to leave us. I know you sent it to us, the capital account balance, right?
You can do that calculation pretty quick, Kevin. But here's the breakdown. While you guys are talking, I just decided to just jump ahead here. I took the amounts of money. I tried to put it into either one of 3 buckets. Sometimes I had to split it. Police, town, and BOE. Because when I read some of these from the BOE, it sounded like stuff that normally we would see in their budget, right? But regardless, I think we can all agree that we seem to have had a, normally for years, we thought 400,000, maybe 500,000 in capital was the right number. To sit here now and look at when we've just now approved, regardless of other factors, what was it, $600,000, John?
I think I sent you, Jim, the capital account. Why don't you put that up on the screen? So
Yeah, I'm going to, but first I will, and I have it in Excel, and that's why we'll be able to do the what we can do, Kevin, real quick. But it seems to me we've unleashed a little bit of there's money around kind of thing. But regardless, I took out this one here, replacement. I didn't put in the tennis courts. I don't know if I got them all in the right columns, but at least if I were to summarize the 3 rather than 4, let me see if I can do that. We're talking about $1,105,000 when you took out this one here, the 15, and this 85. So that's 100. I must have missed something here. But anyway,
we're not going to do that.
Yeah. So at most it's 1.1. Okay. Where are we Santa Claus? Okay. But so going to the fund balance calculation, which I think where you want to go, Kev.
Yes, sir.
Or are you? Were we to deduct money from the projected fund balance, right, of whatever number you want to throw there, okay? And for a starting point, I'll put $1,000,001. Just you can change that number at will, all right? That would give us a different number over here, right? So that would be whatever we say we're going to spend on capital, right? And then what we'd have down here is
you're doubling up on transfer to capital. See, I have a proposed capital transfer in red above.
Oh, you already have that. Thank you, John. I did not realize that. So let's do this then. Let's go back to this question. What is our goal tonight objective tonight regarding this thing we got in the mail for the first time? Usually we get in February. They come explain it first Friday of February. We say thank you very much, and then we go into our budget deliberations. That's usually what happens. What we call Ralph Oakenquist's Capital Group. Clearly, we've never seen 22 items on this list. They
don't expect you to fund all 22. What they did is
they're not prioritized, right?
Yeah, they are prioritized.
And we have said to them every year, prioritize these.
They are. They are.
Okay.
They are.
Okay, they're prioritized. Good.
Yeah.
So add in prioritized list of. So was there any explanation as to why in this year a COVID year, we received 22 requests for more than double what they normally prioritize and request from the Orange Board of Finance. That would be the first question I would have.
Each of the departments had more requests than they've had in the past.
Right. So what's our objective for tonight regarding this list that we just now got?
It's just the one, I think it's what John asked us to approve the $95,000 for the sidewalk repairs at Mariel and the library. And that's all we do. Because we don't know if the budget's gonna pass on Thursday. But Jim, if you could call up the other page Sean sent us, the projected capital account balance was one of the items for tonight.
I think I have it. John, I have them in the Excel document. I thought I have it here. Capital account balance?
Yeah.
Oh, yeah.
Yes.
No, that's not it. Sorry, guys. Is this it, John?
No, that's Amity.
No. No.
No.
No, it's a separate file.
Guess that's, is this it, John?
No.
No.
No. No. The heading's projected capital account balance.
Dated March 15th.
Right. Actually, that date is wrong because I took the balance as of May 12th. Capital balance number 3 is
Let me try this one. This one?
no,
That's not it.
No.
no.
Okay, so let's go by name, John. Capital balance, I don't know.
Submitted budget. Go to the one. Go. No, go
Here,
back. Go
That's
back.
it.
John.
That's it.
Okay.
This
Yeah.
is it.
That's it,
It's
Jim.
got the 15th of March, and now I think I may have put the names on the bottom when I was working to figure out. all the
Okay,
files.
so-
I'm trying.
So right about now, you have about $1 million in that capital account.
Well, John, my question is, and maybe it's just my brain of being exhausted. On the fund balance projection, we have proposed transfer to capital fund of $1 million. We did not do that, or did we?
Well, no, you did.
We didn't.
Okay, so
We did?
we did not do that yet, which
Right.
we probably should wait until see what happens on Thursday.
Correct.
But if we were to do that, because I'm looking at, all right, we have the pipes, we just approved, we did the paving,
Right.
we did we just approved tonight the 325 and the 204.
Right. So that brings us down to the $1,013,000 right
This is
now.
the wrong, Jim, that's the wrong spreadsheet.
Oh, I'm sorry. I went to the fund balance because I heard you say that. Let me go back to here, Kev, or one of the ones.
I was looking down at my notes.
This is
here.
it. No,
That's it.
no,
Okay.
all good.
Thank you.
Okay.
Let's
So
take-
So that, and we didn't approve the pipes yet, or did we?
no, I'm just saying that's coming down the road. That's out to bid right now.
Right, and we need to do it.
Right.
So we're at, after what we've done with the paving and what we just did tonight, and knowing we have to fix the pipes at High Plains, we're down to 813. You're asking for
Right.
95,000 now so that they can, get those repairs done when the kids are out in the library, those two locations. So that's okay, but if we go along, if the budget passes, and correct me if I'm wrong, we're gonna have a vote with this board to move $1 million out of fund balance into the capital
The
account.
capital.
That would be my assumption. And then we go back and hopefully I have better answers on our money coming from Washington and we take another look at this capital list.
Right, sure. But we could still, if we take another 95 out, we'll say we're gonna take 113 out to make it simple. We're down to 700,000 in our capital account, but we're planning on moving $1 million out of fund balance to capital as long as the budget passes.
Correct. I would think at the next meeting, maybe we do that.
Okay.
And we still have that wild card of the OV&A in there. I
Yeah.
did put that in there on the fund balance side.
The 300, and that's another thing, and that'll be for discussion at our next meeting, because everything I've read, again, with this money that they're sending us, which is pennies compared to what other cities and towns are getting, we operated OV&A. Their people, from what I got from our readings, worked at our vaccination site.
Yep.
We should be able to use some of this federal money to offset that cost of their OV&A's deficit, in my opinion. We'll know more in the future, I would imagine, but they paid those people were working for the town for vaccinations, for the pandemic, and that's what this money's for. So I would think we could, plug that OV&A hole with this federal money, but
We may even be able to do better than that. One of the things I did look at, you could use this money for some lost revenue. And they certainly lost revenue because they didn't have the clientele.
Right.
And it looks like there's a 5-year average or something. There's a whole formula in there on how you come up with it. So we're going to be looking at that too.
No, that's good. And all right, so we're on the same page.
Right.
I think they did contact tracing too. So that was.
Yeah, they did a little bit of that also. You're correct. Actually, the school nurses did more of that than the OV&A people.
No, so hopefully we can recoup, or we have enough uses for it as long as it's allowed, and we're grateful for getting anything, but we should, based on the giveaways.
We look at one of these items on the spreadsheet, Jim. Could you go back to the top?
You want to go to Ralph's spreadsheet?
Please.
Yep, thank you. Is that high enough? Let me boost.
Yeah, the one number 7, John. I don't know what an HPU is, but is that something that if we don't replace it and that compactor is shut down for any period of time, we could be looking at, significant expenses from trucking?
Yeah, we had that happen before.
And it'll probably happen again.
Well, how
I don't
dire
know.
is that, I guess?
I don't know exactly what that is, but it is an old piece of equipment down there that he wants to replace. He is trying to be proactive there on that.
So maybe this is something that we replace sooner rather than later.
Yeah, there's a couple of things there. Where is it?
Maybe Jim, you highlight that one in a different color, like orange or something.
Yeah, because I remember years ago when it was down, we had I think it was Anastasios out of New Haven.
Yeah, you had to dump into the dumpsters.
Yeah, they were bringing the large dumpsters every day, rolling in and out, and
who brought this one to us, John?
That was Bob Britton.
Okay.
The other one that's a major one, and I want to wait because I want to see if we could cover it with the Washington money. The computer storage expansion, that's our network here at all the town buildings, and it's running out of room. And if we don't expand that, we're not going to be able to save files.
Well, I mean,
It's
that's
probably
important. We should do that.
But that with some of the Washington money. That's why I want to hold off on some of these. If we could get clarification on the Washington money, it might be where we spend some of these things.
Okay.
Okay.
Yeah.
That's what I'm observing, John.
Especially as a town, John, different from a business. You know, I could delete files that are 10 years old. You know, well, I don't because I have backups everywhere, but FOI, you cannot do that.
No, you can't. I'll give you an example. We had a lawsuit, and Mr. Marino needed emails from 4 different people in the town. So you search by certain words. And Paul Mangillo's first cut at it was 500,000 emails. And I think by time him and Vinny cut it down, it came down to like 200,000 emails that he had to hand over to Vinny for discovery. And Vinny had to go through them and look for the ones that were pertinent. I mean, you can imagine the emails, junk emails, everything's got to be saved.
Yep. Well, I know from my Gmail account with the town, you know, you can't delete.
No.
You know, it's all there, so it just keeps storing and storing and storing. Correct.
Mm.
Nope, that's because it's
John, which
FOI.
was the one you wanted to highlight? Was it not the transfer? I did that for PJ. What was the one you wanted to highlight?
One above it, right?
6. Yeah.
Number 6.
Okay, thank you. So we'll put that.
I don't know why that says Turkey Hill School on that. That's wrong. It's really all town buildings, town network.
How about we just for town network?
Yeah.
John, here's what I'm observing, and Kevin, thank you from. I was getting confused here a lot. So here's what we got. We've got this file that now has got capital, and if we decide, or I don't even remember if we've voted on it, but it sounds like we're heading towards doing those sidewalks. I must admit, when I walked into that building the last 2 times, I don't remember the need, but maybe it's because I live in my driveway every day. Anyway, so that would bring it down to 719 or whatever that number is, Excel 718. So that's one file. The second file has to do with the fund balance. And the third file seems like we have up in the air is this expanded list of prioritized things from the capital committee who have been asked to do a job, and here's what they brought us. So that's version 2 on that. So we have that, and John, I can send you these back and you can do with them what you want, throw them out, whatever. But it seems like we've got 3 things that are kind of honing in on the same thing. We've got this capital reserve account. We have at least one item from the prioritized list from the capital committee that we're saying, and possibly others, all right, that would impact that. And then the third thing is this fund balance item, right? And we have the fund balance items there, and then we have, this proposed transfer of $1 million, and then transfer to OV&A, again, potentially, I guess. And then what that would do to that general fund number, and then that eventually what does that do to our fund balance percentage. They seem to be all honing in on the same concept. We'd want them, get them all in the same playing field to be able to kind of see them at the same time. Am I missing something, John? Does that feel right? John?
Yeah.
Does that feel right that those 3 files are really attracting the same theme?
I'm not sure how you're getting at it. They interact with each other, if that's what you mean.
Yes. Yeah.
Or they could interact with each other. I mean, if you transfer $1 million out of general fund into capital fund,
Yeah, subtracts here and adds on to the other one, right?
Right.
Yeah. Okay. Because that's good, because then if we were to do that, or $1 million, $25, whatever it is, all right, that would put it back over here and increase this 718 yellow thing.
Right. Correct.
If it's $1 million, it's $1.7 million. Okay. And then how much of that you wish to spend, and then what's the impact to our fund balance? Right.
Right.
I'd just like to know more about, I'll be certainly looking at, ceiling tiles at Turkey Hill. It feels like something that should be in a budget. What's this computer printing equipment life cycle management? I didn't understand. See, this is where
that's his program of every year replacing the older computers in town.
Who is he?
Paul, or IT department.
Okay, so that would definitely be over here. Okay, thank you.
We could have Ralph come in at a future date if we want to have him explain some of these things to us, but
He'd be happy to do it.
oh, I know. I think it was my fault that he didn't come to our Zoom all day, our Zoom meeting that day, but just because we didn't know where we were going to be, and we clearly didn't do anything, and we're still not really going to do anything before we have the budget vote and knowing what's going on with some of this federal money.
Right.
And it seems like we have 3 trucks that all of a sudden made the list. We got this Mason dump truck for 80. We got the Sierra bucket truck for 125, and then there's a third one for a little less money up down the line. I forget.
Well, that's because, for instance, the one that's way up the top, you didn't fund last year, so it stays on the list. And every year as we go, other trucks get old and need of repair. Like the bucket truck, they think they could get another year out of it, but it could
Right.
fail in the middle of the year, and then we're going to have to do something about it.
John, I've been around too long, because I remember that bucket truck was approved by Anthony Nastri when he was chairman. We spread it out over 3 years, and I think in 2000 it cost us more than the 125. I thought it was around closer to 180 way back when. I don't remember, but we did spread that, and that's been a deal. That truck's, I was on the board when we bought that truck the first time, and they use it for everything, including hanging the banners for the events on Orange Center Road. And we got our money out of that one.
Yeah, I've been in it. It's been well used, put it that way.
Yeah, no, and I think, and that's a priority the town uses, in my opinion, it's a priority.
And do we usually, finance these things over a couple year period?
I've looked at that. It's really not worth it with our fund balance to pay 4 or 5% interest, 6% interest. It's not worth it. You're just
Our fund
increasing
balance in 2000 was a lot different than it is today, so we did finance it over 3 years originally.
and by doing that, you're actually increasing your budget every year for that too.
Correct. We didn't have a choice back then. We were.
Yeah, I remember. That was a break in the middle of the year or something, right?
Yeah, and we had to, and that's when our fund balance, we had to raise taxes to keep at the old 5% level, and then, to add to Mr. Leahy's stories that they're not stories, they're factual, of the Amity surpluses, that their surpluses are a big reason our fund balance is where it is. And we didn't have that back then. Well, back then we had, I think, 18 or 19 failed referendums.
Yeah, that's by find out before our time. Hey, John, one final one. I know it's the last one on the list, or the last one before crossouts. Tell me about this culvert on Coachman's Lane, Old Country Road.
That's been on the list a couple of years also. There's a culvert on those roads and it has trees growing out of the culvert and the culvert needs to be replaced.
Maybe we need the Boy Scouts to get over there.
You gotta replace the whole culvert going under the road.
Roger that.
It's a little more than an Eagle project.
Yeah, no, that's a big one.
Yeah.
And that might be something we can fix depending on what it's all with the federal money.
That might be one that we can do with the federal money because it did talk about certain drainage repairs and sewer repairs. So we might be able to get that one in on that.
Yeah, because that's been there and that does need to be addressed.
Mm-hmm.
It sounds to me, John, that there's now 4 things that are interrelated, as you say. One is this capital committee item. One is the other list of our capital reserve account. One is what is the list of things? I've heard at least 3 or 4 that might be items. I would like to see us just have a little file, or maybe it's 2 tabs on one file. That would be even better. And you don't have to go from file to file, properly labeled. And then we can kind of see how all these pieces fit together. But Kevin, it sounds to me, I don't think we could go to the fall before we have another discussion on this. Or
no.
What do you think?
No, I think once we get more guidance, hopefully in the coming weeks, because John, we haven't received any money from Washington yet, right?
No, they say it's coming though.
Yeah. So that's
the first half was supposed to come 60 days after the bill was signed. Yeah. I think the bill was signed on March 11th, so they're a few days behind.
What else is
coming? Is it coming from the state or are they coming directly from the federal government?
I think it's coming from the federal government to the state to distribute. But it's a formula done by the federal government.
Oh, I've already written an article about that, right? Yeah. Yeah. It's not based on town population, and it's not based on
some of it is. The money that's coming to the town that goes to county governments is based on population.
Not according to the data that I've analyzed.
Well, that's wrong because it's based on population. I forget what the number is, but it was based on.
Believe me, it's not based on population.
It is. I'm telling you, it is. I'll send you the article tomorrow on it.
Okay, I'll send you the data. All right, I've looked up.
I have the data.
Well, I have the population and the data, and I let Excel do the division. The factor is a factor of 20.
Where did your data come from? Mine came from CCM.
Mine, I think it came from the article in the Hartford Courant.
That's wrong. The Hartford Courant and the Connecticut Post, the New Haven Register, all had different pieces of it. They didn't have the whole thing.
I'll tell you what, if you have the data from those 169 towns, I would be happy to redo the analysis.
I have it. I'll send it to you.
Oh, good. Next step.
And then at 3:00 this morning, we'll all get an email because we know how persistent Mr. Leahy is. And,
hey, listen, I'm just telling you, man.
We know you do your work better than anybody.
I'll guarantee it.
Right now, I feel like at 3:00 we're still going to be here.
I think right.
Right. Thank you. I will send these files back to you, John.
All right. So then, so we can move on and go home. Maybe.
We are home. You're not.
I'm at my desk.
I'm not home either.
Oh, okay.
John's at town hall. So, John, your recommendation is for the 95,000, and Jim, I don't know, how you went into Mariel, but Mariel, that's part of this 95,000, right, John?
Yes. What it is we thought if we put the 2 jobs together, the library and Mariel Tracy, and bid it out as one job, we'd get a better price. and Mr. Britton is going to handle it.
Okay.
It's the part, Jim, it's the part of the ramp that goes up. It's a liability. So
Yeah.
No, God bless America. You guys, if they're coming in and you guys are for it, I'm not gonna, I'm just.
no, I'm just saying for the cost to fix it, one person trips, it's going to be 3 times the amount.
Yeah, I know. And that.
It's actually the handicapped ramp.
Yeah.
Right.
Makes it
Yeah.
even
So
worse.
I will be the one to make the motion. How about that? To budget or
Allocate.
not to exceed 95,000 for sidewalk repairs at the library and the BOE office. How about that?
Sounds good.
A motion by Jim. Is that a second by Pat?
It sure is.
Okay. Any further discussion? All those in favor?
Aye.
Aye.
Opposed, abstained, unanimous. Thank you.
All right. What do we else we got here?
All right. Item 12, discussion and approval of minutes from April 29th, 2021 special meeting.
All right. We don't need that. We don't need that.
All right.
John,
You want me
you
to?
lead off.
Okay. Page 2. I got to read what I put here. Okay. Under D, where it starts off, Mr. Cifarelli asked a board member to entertain a motion to transfer. I think it should say Mr. Cifarelli said the motion would be to spend 600, and I didn't say a dollar amount. I just said an amount out of the capital fund. So
For paving.
for paving.
Okay, good.
And then on Pat's motion, instead of transfer, it should be spend 600,000 from the capital fund. We're not transferring it out. It stays in that fund.
Right.
Right.
For road paving again.
Yeah. Okay, and that's all I had.
Okay. I have, I think, one, maybe two. Under C, up above there, Mr. Leahy made a motion to approve the mill rate of 33.25. The word percent just threw me.
Should be dollars.
No, it should just be
How about we just leave it?
33.25.
Yeah, period. Take out the percent.
Yeah, I like that.
Okay. Down under F below, I'll slide down on the visual screen. You can, however you're doing it. The last sentence of the second bullet. Mr. Leahy will send an agenda. I didn't say I was going to do a draft of questions. I certainly wasn't thinking that, and I certainly didn't send it out either. And I did send it out to you by not 8 o'clock the next morning, but a little after 9. I slipped in. And I think those two things, Kevin, is all I have. Thank you.
Anyone else? Okay, then is there a motion to approve the minutes as amended?
I'll make that a motion.
PJ, is there a second?
I'll second it.
Second by Pat. Any further discussion? All those in favor? Aye.
Aye.
I have to abstain, Kev. I was not there.
One abstention, Mr.
One
Nuzzo,
abstention. Yes, thank
because he
you.
was on the golf course.
Yeah, I was in a board meeting, but anyway. Yeah,
Joe, you'll never live it down.
that's all right. Golf, so just say golf. Yes, golf is good.
I haven't been out yet. Well, if we wanted to save all of us time, and I don't want to level with PJ, we might want to just cut to the chase, John, and take one overview. But we have to look at this a little closer, I think. But I don't know. We're at 3 hours now, so.
Yeah, and the Bruins are losing 3-2 with 6 minutes to go. That's the magic of Zoom.
But it sounds like if I go to the very back of the bus of the revenue thing, and I wanted to get into the details, and I have bunches of questions, particularly on the expense side. I think I'm seeing that we are ahead of the game, even though it says minus in this report. We are ahead of the game for the annual right now ahead of the game by just a tad on the revenue report. Is that correct, John?
That's correct, but there's some adjustments that put us behind a little bit.
Oh, no.
For instance, under the Orange Public Schools, there's
Right.
a excess cost sharing that we have to give back to them every year, and that's
Correct.
187,330.
Right.
So that puts us about 147,000 short of our budget, not goal there. There's also a couple of questionable things like public health nursing and their condition over there. We have 200,000 in the budget. I don't know if we're going to be able to get all that or any of that. And then under Park and Rec programs, self-support programs, we have 60,000 in there from them. I'm not sure we're going to be able to get that also because they had a lot of programs that they had to cancel because of the COVID and stuff.
Roger that, but we're all in tough times. But I went back to our audit report and looked up what they have in their bank account there.
Yep.
Okay. Kevin, you remember years ago we were doing that analysis for, in particular, Park and Rec and others.
Yeah, and we made them pay for some of their stuff that in those tough.
That's right. So, like I say, there's a lot to talk about, and that's one of the ones I had highlighted. But I don't know, we could spend 45 minutes probably going through the details here. But I think what we're saying is we're, at least for May 17th, and again, Kevin, you have to guide us, but given the time and whatever, or we can have another meeting, I think there's some opportunity for, at least for me to learn, and for whoever's watching to be aware and learn also.
Yeah, I probably don't want to, I don't think any of us want to get into the details at 10 o'clock at night.
No.
I personally need to monitor certain files by midnight, but.
No, I'm good with that, Kev. And I would think we could take the same approach looking at the expense side.
Yeah.
Yeah.
In other words, if we did peak at the expense side and we went in Major League, where are we, right? You immediately go to the two school systems to see how much they haven't gotten yet, and that's 3.9. So you're left with 3.9 left, right? And then I went through and got familiar with what I would have numerous questions about. But at least, unless I hear different from John, if he is not concerned, we could push this off, but I don't think we should push it off that far into the future to talk about it. But that's my thought. John, do you have any concerns on the expense side? You've commented about.
No, I think we're gonna be in a surplus over there, probably at least $500,000.
Okay.
Probably more, depending on what gets spent between now and the end of the year. It's still 3 payrolls. There's extra police payroll for holiday pay.
Right.
There's some extra small payments. So there's been quite a few vacancies too.
Yeah. Yeah.
For instance, in community services, the director jobs all year.
Yep.
Some of the other people, the secretary and admin over there has been vacant a lot of the year.
Mm-hmm. Okay, I'm with not delving into it tonight, but I would like us to do that in the near future.
Agreed. Everybody else okay with that?
I'm with that.
Roger.
All right, so then we'll move on. Old business, tropical storm, I can't pronounce it, Isaias. Has that
There's only
changed?
been one ad, right? You can see up at May 12th, there's only been one.
It sure would be nice if we got any of that back.
Yeah.
Yeah, almost $200,000.
It's over 200,000 because there's labor also.
Ah, excellent point, John. Thank you.
There's labor, there's gasoline they're putting in for. FEMA's been a little, from what I understand, more lenient than they've been in the past. And Bob Britton's working with them on it.
I guess so. When you have trillions you can work with.
Yeah, I wasn't gonna go there.
Jeez. Anyway, hey, what's the zero up here? How come we don't have a number? Since we could.
Because it hasn't been paid yet. It's been approved but not paid.
Ah,
This was wrong.
okay.
If I ran that today, I believe that was paid. And
No, I didn't know that payment was triggering.
I looked at that too, and I said, "What's that?" And then I realized that there might be another bill in there since then too from them. I know they were working Saturday. The back part of what do you want to call that? I call it the dump. Whatever they call it was closed to people bringing wood because they were working back there.
Oh, okay. Yeah.
Okay.
All right. All good.
We're good with that. So the next item on the agenda is Mr. Shanley.
Mr. Chairman, respectfully, motion to adjourn, please.
I
Do we have a
second it.
Do we have a second by Pat? All those in favor?
Aye.
Aye.
Double.
Okay, meeting adjourned at 10:09. Thank everybody very much.
I just
Have
have
a great evening, everybody.
Wait,
Quick
Pat,
tomorrow.
issue. I don't see minutes from the March 30th meeting, which is on the calendar showing as March 29th. But I don't see it, Deb, I don't see any minutes. That was the meeting we had at the Board of Ed.
Am I still? No, I'm not sharing anymore. Sorry. I had us meeting on the 30th.
Yeah, but the calendar shows the 29th, but we actually met on the 30th. And there are no minutes, at least online, and I don't remember any.
In other words, we haven't reviewed any minutes from that meeting.
We did. We did.
Yeah, I remember.
Yeah, we did. I just can't get to my my files right now from.
They're approved, Pat. I'll send you.
Oh, okay.
They're all set.
All right.
I just looked. I'll send you a copy.
All right, well, they need to be posted online. I don't care about a copy for me.
I sent it to Pat O'Sullivan. I can't touch the website.
Okay.
I'll send it to him again with a little note.
I think the problem is with the dates, because it's online, it shows March 29th, but we actually met on March 30th.
Okay, I'll call Pat. I'll straighten it out.
Okay.
Pat's retiring. He's been a phenomenal town clerk.
He's been fabulous.
He's probably, he's allowed one slip up in 20 years.
It's okay.
And for the record, I'm paying attention to everybody here very much, but the Bruins have tied the game with 2 minutes ago.
Sounds like it.
I love these Zoom meetings.
And by the way,
Good night, everybody.
Yeah, good night, everybody. But one last thing, do we see we have a new Democratic nominee for the town? Have we seen that yet?
Yes.
Connor Dean?
Connor Dean, yeah.
I saw the article today. It was emailed to me. So.
I've been friends with his family since probably I was born.
Oh, yeah? Good.
His mom is a Ferguson, All Sports. We all know about them.
Okay.
And Connor actually played in 2005. He was the keyboardist playing Jim Zioli's inauguration at High Plains School.
Oh, you're kidding?
No, I wrote the check. I was the treasurer, so no,
Interesting.
he's a great kid. You know,